system that is set up to extinguish risk.
And we're number one for international debt issuance. So yes, I guess we are going to attract some crime, and we do work to get that crime out.
What is your response to that? That yes, we want to keep people safe, but we also need to protect people's privacy online.
Thank you very much. Good morning. Thank you so much. Wonderful to see so many of you here and several friendly faces too. So welcome back to those who've been to Politico events before. My name is Kate Day. I'm Politico Europe's Deputy Editor-in-Chief. I run the team here in the UK, many of whom you're going to see today. And what a time to be meeting. It's such an inflection point in the world. It feels like this mega election year that, of course, has slightly exhausted, but also really excited all of us here at Politico. We care very much, of course, about the horse race of politics. We cover that day by day and like nothing better than to know what's really going on inside all the corridors of power and the bars around them. But we also really feel our coverage comes alive when we start to unpack what that then is going to mean, where the policy is really going to head and how much these fireworks of political elections are really going to change the world for all of us with a kind of professional stake in politics. That's where Politico feels strongest, and that's where we're most excited to play, and that's where we'll spend our time today. So, of course, lots to talk about. We're going to look at whether the new UK government feels regulations in the right spot. How do they balance growth, managing risk? There's all sorts to talk about there. Do they tack closer to Europe with obviously an incoming commission? Our team in Brussels are all over that in the last few weeks, and today's really quite a key day there too. And then over in the White House, we're looking ahead to Trump, so we can't ignore the US election and what an incoming Trump administration will do. So much to talk about. We're going to get right down in the weeds, as I hope you would expect from us. We very much want your questions. We want to make this useful for you, so please use the Slido app to keep the questions coming. We'd love to hear your thoughts. And for those of you who don't know, they're going to introduce themselves in a minute, but today is really the stars of the show from a Politico point of view are our financial services team here in the UK that's headed by Fiona Maxwell. For anyone who doesn't already receive our newsletter and alerts and articles. There's a morning newsletter, much like a playbook, but focused on the world of financial services regulation. So written very much with people like you in mind. There are free trials available. So if you don't have it already, please speak to one of the team and we can get it. But without further ado, the final thing for me to do is just to thank the sponsors. ClearPay, ISDA and City of London. Thank you very much. Without you, this wouldn't be possible. And then to hand over to Fiona and the team to get the conversation started. So over to you guys. Thank you very much. Go ahead.
Hi, everyone. Hopefully you can hear me. Good. Thank you all so much for coming. It's going to be a great day. We've got so much to talk about. And as Kate said, it's been an absolutely huge year in terms of geopolitics, and the financial services industry is not immune from everything that's been going on, even in the wider context in the EU and the US, and obviously with a new government here. I think we'll just get started straight away because we just have about 10 minutes to discuss what we think kind of the main topics we'll discuss today, and also what's going on in the financial services world at large. So I will introduce my top team. So at the end, we've got Hannah Brenton, our senior reporter, and Eleanor Myers, our reporter. For those of you who know us, you will notice that we are missing one reporter today. James Fitzgerald, our resident Aussie, is actually back home in Australia for a couple of weeks, so unfortunately he couldn't make it. But let's get straight to it. I mean, I just heard in the initial video last year, the former City Minister, Andrew Griffith, saying, you know, we don't want a system that entirely eliminates risk. Now we've got a whole new government, a different party, a different side of the political spectrum, but the message seems to be the same. And Hannah's got a terrific story out this morning about how you know, the Labour Party really wants to get quite close with the City of London. It's said things like, what do you need? Let's co-design regulation with you. So what do you think, Hannah? Is that, you know, what does that mean for the City of London?
Yeah, I think that's one of the big themes that we've been trying to cover at Politico, is the kind of continuity between the previous government and this government in terms of the attitude towards the city, and particularly also some of the language that we've seen the top of the Labour Party use, including Rachel Reeves in the Mansion House speech on risk-taking, and that's what the city really wants to hear from the government as well. So they've really been on a charm offensive, and it's also been really well received, I think, by the city. So they're very much kind of working in lockstep with the city at the moment on what they want, on the policies that they want, in the bid to have growth and improve the competitiveness of the city as well. They're very much on board with that message.
And they are explicitly encouraging risk-taking now. You know, Rachel Reeves said in her Mansion House speech, we don't want to eliminate risk from the system. She wants the FCA, the PRA, to find ways to encourage firms, encourage consumers to take more risk. And I think that's interesting as well, because we do have entirely independent regulators here. But in the last 4 months, the Labour Party's got a little bit involved with some of the topics. One of those is what we like to fondly call the name and shame proposals from the FCA. So Eleanor actually was up nice and early this morning reading a document from the FCA on its latest name and shame proposals. You should have had that in your inbox about 40 minutes ago. But Eleanor, maybe you can explain the latest and what the FCA is thinking, and also whether this kind of is enough to appease the Labour Party's concerns that it kind of won't be a competitive proposal.
So the FCA announced this morning that they are going to shift their name and shame policy in certain ways. This is the policy by which they're going to announce investigations publicly if they believe that it's in the public interest. So they're now going to give firms 10 days to be able to make formal complaints. And they're also going to be considering the impact on the firm and the impact on the market when they choose whether to announce it publicly or not. And that previously was not being considered. Whether it will be enough, that remains to be seen. The FCA said in the document, we only bring out 10 to 12 investigations a year, so they did kind of try and emphasise that it's very unlikely that they would feel the need to publicly name firms. They gave the example of their investigation into PwC and its audit of London Capital Finance as one which, you know, perhaps would have been named publicly. And their reasoning behind this was the FCA was kind of, you know, criticised in Parliament during that period, and you know, they believe it would have been better for consumers in that case. And you know, it suggests perhaps because of this reversal that there has been a nudge from the Treasury that obviously wasn't made public. That is a different kind of style than the Tories, because Jeremy Hunt did say publicly that he wanted the FCA to relook at the policy. And I think that's a theme. You've seen it as well with the payment systems regulator and its decision to reverse its authorised push payment fraud reimbursement policy, quite a mouthful. The upper limit was supposed to be £415,000, and then in about a week and a half beforehand, they said it's going to be £85,000 in line with FSCS. And you know, we had heard that there had been, you know, a bit of a nudge from the Treasury, but behind the scenes.
Yes. Okay. Great. And let's talk a bit more about the City of London in the context of, you know, the wider world. Obviously, we'll talk quite a lot about the US election, things like potential tariffs. But I'm really interested, for those of you who don't know, Hannah has been with Politico for many years and used to be based in Brussels, so is also an EU expert. So I'm really interested what you think this kind of Brexit reset that the Labour Party is pursuing, if and how that will impact financial services.
Yeah, I think it's a really big open question, but the answer is probably not that much, because a lot of the dividing lines on financial services have kind of been set since Brexit. So the question really is what the government would like to see from Brussels and what Brussels is kind of willing to give as well. But there is a kind of outstanding question, and we have a panel later in the day on the EU-UK relationship as well, but particularly on Euroclearing, the EU granted, it's the only area that the EU granted the UK equivalence after Brexit, or still is granted equivalence, and that comes up soon. So the new incoming Financial Services Commissioner in Brussels needs to decide pretty quickly what to do about that. And it's likely it will get extended, but there's still questions about how long, and the tone of that might also say something about where the relationship is heading to.
Yes, that's a very interesting point. And also we are interviewing City Minister Tulip Sadiq later, so I'll definitely be asking her about that. And Rachel Reeves is actually going to Brussels for the Eurogroup on December the 9th. So all of this does point to kind of closer ties with the EU, but of course we'll see how the US election and the potential for the UK to want to perhaps create closer ties with the US, how that kind of impacts the EU-UK ties. But going even wider, looking at things like foreign policy and how Labour's position on Russia's invasion of Ukraine, how kind of what they want to do about sanctions, wider foreign policy. Do you think that's changed really between the Tory government and the now Labour government, Eleanor?
I think, so David Lammy did make a big, he spoke a lot about kind of dirty money and sanctions on the election campaign. It was something he was, very passionate about. Just last week we had a package of sanctions which were a kind of thematic sanctions. They were anti-corruption sanctions. And I read actually in the press release, they used the word corrupt or corruption 22 times, so it's not very subtle. But I think it's showing that you can use sanctions for sort of different political agendas. It's not just human rights abuses or war. They also, if you want to, focus on anti-corruption and the City of London's role in that, that's something I think they're pushing forward.
Okay, great. Right, we are very close to being out of time, and I know we've got a packed day, so I think I will leave it there. It just remains me to say thank you to my top team. You'll see more of us throughout the day as we are interviewing some great panellists. And Hannah is up next with a panel discussion on banking regulation. So I think if you just bear with us for about 30 seconds while we put some more chairs on the stage, and thank you very much, everyone.
Great, so welcome back to this panel on banking regulation. Now we've rearranged the chairs. As you heard in the first panel, I'm Hannah Brenton. I'm a senior finance reporter at Politico, and I'll be taking questions throughout this session on Slido, so please do submit them. And with me on this panel, I have a great lineup of speakers. So to my left is Scott O'Malia, Chief Executive of the International Swaps and Derivatives Association, Baroness Bowles of Berkhamsted, a member of the Financial Services Regulation Committee in the House of Lords, David Pinto-Dushinsky, Labour MP for Hendon and Chair of the Financial Markets and Services All-Party Parliamentary Group, and last but not least, Mark Garnier, Conservative MP for Wyre Forest and Shadow Economic Secretary to the Treasury. So to kick off, we've had some kind of rocky moments in the last 5 years in the financial system. There was the dash for cash at the start of the pandemic, the fallout from the mini budget here in the UK, which both required central bank interventions to calm markets, and the 2023 banking crisis that brought down Silicon Valley Bank and Credit Suisse. So in this panel, we're going to be talking about some of the lessons from those moments, from those wobbles, what kind of regulatory agenda is still on the table, but also within the kind of bigger economic context of the search for growth and the arrival of President-elect Donald Trump in the White House. So, to start off on the banking side, Scott, if I could ask you, one of the major pieces of financial reform since the crisis has been the Basel framework. Where does that stand, and what does Trump's arrival mean for that?
Well, first of all, thank you very much for having us on the panel. Happy Thanksgiving to everyone out there. It is interesting to be between a reporter and 3 government officials. I do feel like the turkey dinner I'm about to cook. But let me respond to that question. We don't know what it means yet. We were on the verge in September. Michael Barr he's the vice chairman at the Federal Reserve, of putting forward the long-awaited Basel Endgame. And he had promised significant reforms in this speech, vague, but pretty significant reforms. Now, the U.S. is the last one to go. Of course, one of the largest economies as well. So it's for all the marbles. We at ISDA are very focused on the trading book. And in there, we found a number of excessive increases in above Basel, and certainly above the UK and the EU counterparties of which we kind of benchmark things. The trading book is super important because it's a global trading market, and we really think about this in kind of a level playing field issue, and we really saw some real significant differences. And we don't know what the future is going to bring. We do expect some significant changes, and timetables are also a big change that we're certainly watching. Ideally, we would maintain a consistent global framework, a level playing field, and let firms compete, and making sure that we don't have a regulatory bias towards any one jurisdiction or nation. Some of the big things that we found problematic in the U.S. legislation, first and foremost, was the punishing treatment of clearing. Most U.S. interest rate products are cleared here, but that doesn't escape the clearing charges in the U.S. So at ISDA, we fought very hard to bring down the cost of clearing. Most importantly, what we want out of this is deep, liquid markets and risk-appropriate rules. I think as we go forward, you mentioned some of the crisis issues out there. All of these were liquidity events, right? We have put together a banking framework and a regulatory framework that is very focused on counterparty risk management. Now we have to deal with making sure that we haven't made the market too fragile and that we don't create episodes of liquidity in any jurisdiction. So what we'll be looking forward is, rules that are risk appropriate, and we've done a lot of work to calculate that and what that looks like using quantitative impact studies, and fed that back to regulators. We want deep liquid markets, and we want level playing field across jurisdictions. So, and timetables to sort that out as well. So if the U.S. is significantly delayed, the impacts here in the UK, certainly in the EU that have already kind of put their cards on the table and put implementation timelines, we're going to want to see if we can adjust those to make sure that we implement in a consistent fashion.
So you'd want to delay in the UK if there is a...
We will want to align them, Anna. We don't delay anything.
Okay, Mark, if I can ask you to respond to that, is that something that you think the Bank of England should consider if there is significant changes on Basel in the US? What should kind of happen here in the UK?
Well, we haven't implemented Basel yet in the UK, and I don't think we're going to be implementing Basel 3.1 until 2026. So we're taking a bit of time to see that coming through. I mean, I suppose my take on this is that, and I agree with everything that Chris has said, but the world is becoming an increasingly complicated place, and we slightly arrogantly sort of tend to talk about the world as being what we see in the Western world. So we look to see what's happening in America. But I can remember, up until relatively recently, until we lost the election, I was the Prime Minister's trade envoy to Vietnam, and we were doing a lot of work trying to help Ho Chi Minh City become a financial services hub, not just for Vietnam, but for Indochina. And it was quite interesting because we were very much trying to make sure that we had the UK sort of common law and regulatory regime in place so we could make it easier for UK businesses to come out there. But actually, if you see areas like the Asia-Pacific Rim going on its own direction in terms of regulation and sort of led by China, then you can end up with two kind of different blocks across the world. And so we have to be sort of mindful of what's happening elsewhere in the world and whether that can preclude us from getting involved in it or can we persuade them to follow our way. But look, all the point about liquidity pools and resilience and all the rest, I think, is incredibly important. I suppose the final thing that I'd say is that we have to be very careful that what we don't have is a situation where compliance gets super expensive for everybody, which of course ultimately then goes on to the cost, to consumers. And that in itself can hold back sort of growth amongst businesses, who are trying to use this stuff. But I still come back to the fundamental point, which I've always made about banking, is that banking is almost sort of socialistic. It is socialism in its purest form. It is taking money from where it's accumulated and delivering it to where it's needed. And that sort of very beneficial, function that banking does is something which is incredibly important for economics and support of businesses growing who need to find cash. And that's why we need to get this absolutely right.
And do you think the UK has got that balance right on Basel at the moment?
I'll have to come back to you.
We'll have to see what the US
We'll have
puts
to see,
forward.
yeah.
It's a competitive market. We want to make sure that we don't, one jurisdiction doesn't gold plate or reduce their standards too much.
Yeah. David, do you feel the same? Is there a special place the UK can stand in this debate?
So it's really interesting, and I'd like to echo some of the points that we've heard here. There's a kind of national level and an international level. Nationally, our Basel 3.1 has been, relatively a story of consistency. So, in fact, the PRA's recent guidance, tweaked only a few things at the margin. They listened a bit to the industry on SMEs, on property valuation, on trading, on trade finance. But it only had a 1% impact on overall capital levels if fully implemented. I think the contrast is then with the international picture, where I think, to pick up the points that Mark and Scott have seen, I think we're seeing a potential risk of real fragmentation. So the centrifugal forces are really quite powerful here. We've seen it in the Basel Endgame U-turn even prior to the election of the new administration, which I think has quite profound effects. I mean, it didn't just halve the capital requirements, it's also critically, and I think especially for the appreciation of US banking, move the threshold for who's actually covered by the full fat Basel rules from 50 billion of assets to 250 billion. That's a huge move, and that essentially will take quite a lot of the US banking sector out with some of the core of Basel. We also saw their big changes on op risk, which I think will again make a huge difference to some banks, but could lead to a real divergence of paths. And so I think we're going to see this, I think the risk is for potentially quite a lot of centrifugalism, one, and two, to kind of pick up on Mark's point, I think there's a lot more politics with a small p that will come to the fore. So already we see discussions with US regulators where they are concerned about institutions' exposures to China. And I think as we get more politics, more of the politics of quote-unquote national champion banking, I think that will also have an effect. So I suppose the question, I think Britain is absolutely, doing the right thing in terms of trying to reflect the core, I think sticking quite close to the Basel, the spirit of the Basel Committee's recommendations. I suppose the other thing I'd flag, and it came out in the Mansion House speech, as Rachel talked about a reset with Europe. The other thing, obviously, we're trying to do is not just work out where the States is, but how we keep the right relationship of equivalency and convergence with kind of Europe. And so maybe we'll see a bit more of that. But I'd be tempted to echo Mark's view that I think we need to slightly watch this space, because the core message here is one of uncertainty.
Mm-hmm. Sharon, do you agree with that? You worked in the EU for a long time, so do you see a risk of more kind of fragmentation on these kind of global standards?
Well, that might be the case if the US decides to be an outlier. And I mean, in some ways, they have been a little bit compared with the EU and the UK on some issues, but there are other ways that they've aligned. But I'm more interested in some ways in the things that we're doing at home, where we're shooting ourselves in the foot already, where we are, it's the gold plating. And one of those issues is MREL, where we introduce MREL when banks are at the size of 15 to 25 billion, whereas in the US it's $100 billion, and in the EU it's 100 billion euros. And the effect of this is that once you get to a reasonable size, the size of something like Paragon Bank, they have to sit there and think, well, are we going to go in for this sort of super expensive MREL, because it's very expensive when you're a smallish bank to do it? Are we going to grow and get captured, or are we actually going to stay at this smaller size? So the effect of that is we are just not getting new mid-sized banks, just the kind of banks that would want to be lending to businesses that might be regional and know more about their area. So, the very first thing, if you get on the growth agenda, is, well, we have to look at this, because otherwise you're not going to get the money going into where you want it to help the growth agenda amongst the business community. And I just cannot understand why there isn't a huge political noise about this, and why there hasn't been. The fact that you cannot criticise the Bank of England, and that there really are very few ways in which you can influence it, to my mind, has actually gone too far. And I think that came out when we were discussing the recent bank resolution bill as well. We wanted some quite mild little things, to know how things were going to work out. We managed to get some reporting back, right at the end when it's all finished, but they don't even want to have to think about anything else other than the problem that is there, and say, therefore, you can't be accountable for anything. You move into that kind of area as well, where you're looking at bank resolution, where we're now going to be using private funds instead of public funds for a public interest point, and you've no extra, are you sure this right check, then that worries me.
So for anyone who doesn't know, MREL is loss absorbing capital as well. But so do you think, particularly with the bank resolution bill in mind, that was brought forward as a response to some of the bank failures last year, and Silicon Valley Bank in particular? Do you think that means we're not learning the right lessons by bringing forward that bill?
Well, I think that the bill, it was a bright idea that with Silicon Valley Bank, which we should remind ourselves that one of the reasons we actually want uniformity in how we apply Basel is we want to also minimise contagion. So we had a touch of contagion there, and then it was rescued using public money. Now, if it had gone into resolution, it would have triggered the Financial Services Compensation Scheme for deposits up to 85,000. And so the bright idea is, well, actually, the Financial Services Compensation Scheme hasn't had to pay out. So if we come across a similar situation again, and it's decided that it's in the public interest to save it, rather than to go what they thought was going to be the normal route of bankruptcy and dissolution. If you're going to go down the route of saving it, then use the Financial Services Compensation Scheme as a pot of money, and then that, of course, has to be topped up by all the other banks. So you've got this rather strange scenario now where the banking sector has to pay a levy in order to bail out its competitors, which is where I'm saying we're now using private money to bail out in the public interest instead of public money. And we just felt that there weren't enough handles over that. So it was a good idea, but it's also showing that we're now thinking much more that resolution is going to be what is happening. From the Parliament side, well, we actually amended it. I mean, all of us on the opposition benches and the cross benches, we all thought that it should be limited to small banks, and we put an amendment in to that effect, because otherwise, is MREL, this expensive MREL, ever actually going to be used? And we became, concerned that that was the case. And I think it opened a lot of questions about what do we really think is going to happen, and have we made the right choices historically?
Yeah, so this bill now heads to the Commons. So, David, do you share those concerns about the right choices?
I've got to admit, I take a quite different view. So let's step back and start with kind of the Mansion House speech. We've talked about moving from an area where we regulate more for risk to where we regulate more for growth. And Rachel's talked about having the most pro-growth package of measures since the global financial crisis. What has to come along with that is a sense that we don't create asymmetries and moral hazard. And so where I suppose I disagree with Baroness Bowles is that clearly, and I'm very scarred, so I was, I'm not just a chair of the APPG, I worked for many years for Standard Chartered Bank as a managing director sitting on their Africa management team, heading up parts of group strategy. I was also an advisor to the Chancellor during the global financial crisis. And one of the problems we faced was this asymmetry of private risk, but public money when it goes wrong. And so, part of the foundations of creating a safe, kind of safe environment in which we can incentivize growth more is making sure incentives are aligned. So point one, I think that is right, that banks bear their own risk rather than laying it off on to the public purse. Point one. I suppose point two, for me, the really interesting lesson of Silicon Valley Bank, which is why I think these measures are so important, is that when I actually look at what happened in SVB, at Signature also, at Credit Suisse, I think one observation and then three conclusions. My observation was in many ways these are very traditional bank failures, right? We see massive failures of governance. We see failures of risk management. And so it's not due to lack of capitalization. It's classical bad running a bank and it not being and it not being governed properly. In the case of all three of them, to lesser grade to extent. And when I look at the regulatory responses, I think Britain actually did really well. SVB here was small enough that it could have just gone through bank insolvency procedures, but the regulator was fleet of foot. And actually halfway through the weekend worked out that would have added to contagion risk. So they shifted to shifting accounts. Contrast that with what the Fed did. If I want to go to the root causes of the SVB failure, and by the way, the Feds held their hands up in the official report, the bank was below the threshold for full kind of Basel III full fat gold-plated regulation, but expanded massively. And yet the Fed didn't adjust their approach, even when it was clearly bulking up on steroids. So for me, big lesson one is regulators need to be flexible and need the tools for that. Lesson two is that they also need to have the capability to do basic regulation of governance. And so some of this has been good at the basics. And I think the bill helps with both of those things. I would say one final thing, though, which is, for me, in some ways, the most interesting failure was the Signature Bank one. Because although traditional and they had too many crypto assets and clearly didn't know how to manage them, it was also a flash crash. Right? The combination of Twitter plus banking apps meant that you had a run in hours rather than the runs we saw in 2008, which were horrible but took some time to emerge. And so again, this again comes back to, so therefore regulators need flexible tools to move fast. And I think the Banking Resolution Bill really helps with that.
So that brings us to a question from the audience that's on a very similar note. So from Simon Hills at UK Finance, do you see bank failures as regulatory shortcomings or supervisory lapses? So Mark, if I could get you to weigh in, do we need more regulation or better supervision? Or
It's a really strange one. I spent 3.5 years on the Parliamentary Commission for Banking Standards, and we were going through a whole load of kind of this in absolute minute detail, and the Treasury Select Committee scrutinising FSMA 2012. And there's just listening to this sort of conversation, I sort of kind of go back to the first principles, and sometimes we can get caught up in tactics when actually we're trying to work out what the grand strategy is and all of this sort of stuff. And I think, David, the point you make about regulatory flexibility, I think, is incredibly important. But ultimately, life is risky, and we've got to be able to sort of understand what is just risk that is going to be inherent in a system, and risk that is stupid and we should be able to rule out. And it's one of these very, very complicated problems. Is it how do you try to have acceptable risk, and then at the same time educate people about what that risk is? Because ultimately, we cannot immunise everybody from every single problem that can possibly happen, be it a banking system or from a global pandemic from COVID or whatever. So we have to try and work out what it is we're trying to achieve. And I think it comes down to those fundamental points of, are we going to isolate contagion? So we've looked at things like ring fencing and all that kind of stuff. And again, I come back to the Banking Commission. There was a whole load of stuff which we brought in, which we're not entirely certain was the right thing. And one of the early failures of that was the reversal of the burden of proof. Where if a bank failed, it was assumed that you had got it wrong as a manager, and therefore you should be held guilty of it. In the end, it was just you can get around that with a compliance pro forma way of dealing with it, and it never really kind of properly worked. So I think we do have to keep modifying these things, but we have to keep coming back to this grand strategy. We have to accept that there is going to be risk in banking systems. We have to accept that we're not going to let it spread. We've got to have regulators who are actually sensitive to the need to be flexible in all this kind of stuff, and make sure that they aren't falling into that trap of any institution, which places as its first duty of keeping itself in existence and its second duty of delivering whatever it is it's meant to be delivering. And I think that we need to make sure that when we bring about the growth agenda and the international competitiveness agenda and this stuff, which is very good stuff in the Mansion House speech, that it gets built into the way the regulator works and isn't something which they pay lip service to and then keep drifting back. So it comes down to things like the Treasury Select Committee, making sure that the long-term objectives are being maintained. And as I say, that comes back to grand strategy versus tactics, and we could get bogged down in the tactics and miss out on what the grand strategy is.
In that sense, in the grand strategy sense, do you think that the message from the government has been very clear to kind of encourage more risk-taking? Do you think that do you agree with that message? And is there a sense that financial rules in general have gone too far since the financial crisis?
I think I think some of them are very good, and I think sort of the micro detail, as Sharon was talking about a little bit earlier, about these caps of where you set the sort of transition from one set of rules to another. If you over-egg the pudding, then you end up stifling things domestically. So you have to be very, very careful. Look, I think the general sense I'm getting back from the city is that people are very happy, welcoming cautiously what's being said. And my view on all of this is that I think I'm aligned with Rachel Reeves at the moment, but we absolutely need to see more details about what's coming down the way, and then we can sort of go into the fine details, coming back to that tactics versus strategy thing to make sure those tactics are the right thing. But yes, when it comes to accepting that risk has got to be there, then yes, I agree with her. But I think with that comes a requirement to make sure that people understand what risk is, and that if things do go wrong, to a certain extent, you are going to be, possibly be hit by that, and to understand what that means. Obviously, that means that you've then got to make sure you balance that with people then not being prepared to take any risk at all because they're worried that you're introducing other risks elsewhere. So it's going to be sort of complicated in terms of little spider's web going on. But yeah, look, as I say, we are looking at what Rachel Reeves has said with the Mansion House speech and all the rest of it, and we welcome that direction of travel, but we've got to be able to be satisfied that the detail delivers that strategy.
Okay, before we move on to talk a little bit more about non-banks, there's another question from the audience on the Basel Committee from Orestes Niclou at Deutsche Bank. With all the focus on competitiveness in the UK and the EU, let alone the US, is there a future for global standard setters like the Basel Committee? And somebody else asks, will the endgame actually ever be implemented? So I guess those bigger questions about the direction of travel on global standards, where are we heading?
We have to use the Basel Committee. It's essential to have these aligned and have regulators in a convened environment discuss the trade-offs. All the points made on this panel today, what is the trade-off between safety and soundness, economic development, safe liquid markets, and trying to figure that out. Spotting new issues is critically important. We'll probably get into this overly egged non-bank financial intermediation term that people are using, but I think the Basel Committee serves an important role. And in fact, once we do get this, and I do think that the Basel endgame, I've got to believe it, will play out in the US eventually. Once we do have that, we need to begin to say, did we get it right? Right? Are there areas where we need to sand off some rough edges? Do we need to fix some things? We have to have good alignment on clearing. Clearing is a safety tool that we must have a robust safety device around that, and we have to have global recognition around that. And I think that's an area that we still are fighting through in the EMIR rules. We also have to make sure we think about risk in an appropriate way, and have we overdone it on internal model application. And I think that ought to be revisited, if not rolled back, to make sure that we serve what regulators are concerned about, the opacity of the models, but at the same time ensuring that we have good, proper risk management going forward. So there are a couple of big issues that we're looking at in those areas to make sure that we do have consistent global alignment and a safe system.
But you think the global rules are still coming, though?
I do.
Yeah. Does everybody else agree with that, or do you think there's more of a chance it might not happen?
I think that they've proved their worth, really, because you go back to the financial crisis in 2008. That is a long time ago, and in the normal cycle of things, where regulators tighten and then it gets looser, that's more normally been 5 years or something like that, and that hasn't happened because there has been this international alignment. So we actually have had this period of stability, and therefore I don't really think that we're going to want to let go of that, wherever we are. And the introduction of central clearing and other things has been a big part of that. So we've stopped this swinging pendulum, and I don't think anybody wants to bring it back. So they're here to stay, in my view.
Yes.
David?
No, and very much to build on that. If you just to take one example, which is of increasing in importance here around sustainable finance. Currently, I think I'm right in saying there are 60 separate taxonomies, which is actually impeding the creation and growth of the market. And that gives you just an example of the route you start going down if you don't have some kinds of global standards. So I think we all have a very strong vested interest in ensuring those. I suppose the question will be, A, on their scope. I also agree with Scott. I think it will land. I'm really struck. I have a slight sense of deja vu in the sense that when I was at Stand Chart, I was in a room just like this, on this street, on a cold November day, and we were talking about the fact that, oh gosh, Basel III may not be fully done till 2019, and it had been pushed out. So we're now looking at 2026 with, although Europe probably a year earlier. But I think we will get there, I suppose. But there is a bit of a question about will it be quite as all-encompassing as once was? And I think part of that global discussion also needs to be on what's absolutely essential to have convergence on, versus what bits are going to more reflect national stuff. And when I look at the difference between even our markets and, say, European ones, and the kind of slightly overbanked nature of Europe and the way their markets are far more bank-led, you can see there might be, there might be less convergence than was once hoped, but I think they're absolutely essential, and I think they will happen.
Okay, I think that brings us quite nicely to the non-banking side, because that has been an area where there's been a lot of global regulatory focus, and there's work going on at the Financial Stability Board on leverage. And actually tomorrow we also have the results of the Bank of England's first kind of major stress test of non-banking, so it is both national and global. So do you think there is, in this debate about where global standards are heading, is that an area where there is still going to be that focus, or is there a risk that none of this really is going to happen now? Scott.
I have some frustration with this grand characterization of non-bank financial or shadow banking. First of all, this is not a monolithic industry, right? This is, you've got hedge funds, you've got pension funds, you've got insurance funds, you've got private equity, all doing different strategies. They're not investing in the same way. They're not all behaving the same way. So to characterize them grandly or in one bucket is inappropriate, and you kind of miss what's really going on here from a risk basis, and we need to think about that. I think what we need to go back to as first principles is look at the data, right? We've been reporting data in all markets in not an excessive amount, but there's no lack of data that's being reported to policymakers and regulators. Look through that data. Tell us what you find in terms of risk and exposure. Work through that first before you ask for more data, because this is an expensive tool.
That's what the Bank of England's going to do tomorrow, though, isn't it?
Fantastic. We'll take a look at that. The next bit is, as we think about, is have the tools we've implemented done their job. So we've already been talking quite a bit about bank safety and soundness through the Basel Committee and those rules, which have increased before we're about to get to the new implementation in 2026 and beyond. There's also the non-cleared and the cleared rules, right? That is in non-cleared alone, we've added over $1 billion, $1 trillion, $500 billion in clearing, more than $500 billion in clearing alone, or 500 billion, sorry, $500 billion in clearing alone. Mm-hmm. So we have a lot more safety and soundness around all of these participants. What impact does that have? We've had an exhaustive look at both the non-cleared and the cleared rules Is pro-cyclicality a feature or a flaw? We believe it's a feature because it makes clearing accessible. The non-cleared rules have been very stable and resilient, and we've tested it through some of the examples that you said. So before we start reinventing the financial regulatory architecture, let's make sure that we're looking at, are the rules working today? Have they been resilient in these things? So I think all of that evidence is going to kind of point to yes, it is working, and let's maybe calm down a little bit before we start developing a new set of regulatory framework.
Okay. David, do you agree with that? They kind of need to take stock first, or are there issues that really need to be addressed straight away?
So look, firstly, I wouldn't claim to have deep expertise on this. I suppose I'm struck by a couple of things, and by the way, I don't speak for the government, this is very much me speaking for myself. When I look back at some of these markets, one, of course, we want more capital invested in Britain, we want deeper, more liquid markets, and to an extent we're somewhat agnostic as to where that capital comes from. Equally, I am struck by what happened in LDI. And at a 30,000 foot level, as a layman, I could say what's really interesting about what happened with LDI is that the story really echoes what happens in banks in 2008. You have funds that don't really carry enough buffer, that haven't really understood the degree of volatility and risk, because we did have an extreme risk, extreme volatility event in the movement of gilts, and hadn't really understood the degree to which counterparty risk can become liquidity risk, and liquidity risk can become solvency risk, right? Now, those sound very much like the lessons of 2008. And so, I could say, isn't it interesting that market participants were still relatively slow to learn them? Point one. Point two was obviously, look, without getting too party political, obviously, we know the role of the mini budget, but leaving aside the really poorly thought through decisions of that budget that caused havoc for our economy, it also all happened at the same time as quantitative tightening. So the lack of policy coordination was catastrophic. And so both of those things for me point towards, yes, you don't want to overregulate, but you do need some kind of framework to make sure lessons are being learned and these things are being watched. I would say one also final thing, which is all of this does point to a third lesson, and again, not being party political, which is you cannot separate the macro-prudential from the macroeconomic and the governance. The fact was, in the last 8 years, Britain had 5 prime ministers and 7 chancellors. In the last 14 years, we had 11 city ministers, half of whom only served less than a year, right? That itself is not the basis for macro-prudential stability. So I think, yes, I personally think there are lessons to be learnt there, but you need to get that broader framework of stability right, and that's absolutely what we're trying to do, as a new Labour government.
Mark, do you think the right lessons have been learnt from the LDI crisis?
Look, David, you're being incredibly polite. I mean, I'm a Conservative member of Parliament. Let's not beat about the bush. That was a bonkers budget, and I think the important point about it is, look, your points are absolutely right. I agree with you 100%. And what was extraordinary about that? I can remember just after we had got rid of Liz Truss, I was in Singapore a week later with the International Trade Select Committee, talking to investors and about the UK. And this is the point I'd make to everybody. Actually, we had a disaster. I mean, it was appalling what happened with that budget, and she went against a whole lot of the standard rules, which you should have had. Every chancellor should run their own budget, and she took control of it. Every prime minister should listen to the advisors, and she ignored all the advisors. But what was very encouraging about the UK then was the political system healed this very, very deep wound very quickly. And it took, 2 or 3 weeks before we finally got rid of the cause of this problem. And let's not beat about the bush. I mean, and it's been a problem for us subsequently, as we saw at the last election. But the system kind of worked. But look, you're absolutely right. I mean, at the end of the day, you've got a lot of different things that are coming together. So you've got the Bank of England, which is independent. I mean, it's legislated to be independent. So quantitative easing or quantitative tightening or whatever, because it turned into quantitative easing straight after that problem erupted, it came there and did it. But it's got to be independent, because if it isn't independent, then how are you going to have this sort of, what Gordon Brown brought in when he gave that independence was a very good thing. And we don't want to change that, because if you keep changing things, you lose confidence in the system. So there's that problem. You've got to have politicians who understand how the system works. And when you were an advisor to the Chancellor, as you were saying you were, if the Chancellor can take your advice or ignore it, but they've got to listen to it. And that was the problem we had with that mini budget. So as long as the politicians are playing the game properly, then that's absolutely fine. And then the other thing about learning lessons from history, so we talk about learning lessons from the 2008 banking crisis, and we then sort of subsequently see other problems coming through later. And actually, all the reforms, the banking reform, FSMA and 2012 and the Banking Reform Act, were all about sort of basically having sort of insulating the system so that you didn't have contagion across it. But it was rather like kind of the Titanic in terms of trying to make sure that you have watertight doors. It doesn't always work. But what we didn't do was learn the lessons from the Asian banking crisis in 1998. And the Asian banking crisis was where you had a huge amount of money being lent to the property market at very, very high, also very big ratios. And as a result, when the property market came down, the banks got nervous about understanding what the price of property was. So they kind of prevented people from selling property until this thing compounded and compounded and compounded itself. And then wind forward 10 years. And we had a system where you were where you had these derivatives, where there was this wonderful analogy of what was going on. It was the Gillian Tett, I think, from the Financial Times, who talked about a butcher, and if a butcher finds a green pork chop on their counter, they can do one of three things with it. They can throw it away. They can take a punt and take it home and eat it themselves. Or the third thing they can do, which is what you shouldn't do, and what did happen in the banks, is you chop it up with all the other good pork and then put it into a whole lot of pork sausages and sell it to everybody through these derivatives. And the result was the contagion spread through the system through these derivatives. And yet we had the fundamental cause of it, which was bad mortgage loans, we hadn't learned from the banking crisis in Asia 10 years earlier. So absolutely, the lessons of history are incredibly important, and we really must sort of understand that. And I can bet your bottom dollar in 10 years' time, we'll be looking at another banking crisis that we won't have learnt from LDI. So something will happen, and we haven't quite picked it up. So ultimately, this is why I come back to this point about the grand strategy, not the tactics. We can get bogged down in what has happened today and try and work out how we can sort the problems out tomorrow, or we can try and understand what the really big picture is and make sure that those fundamental kind of tactical flaws don't create contagion, which is why you need to introduce this risk element to allow banks to fail, to allow there to be a cost, potentially to consumers. I mean, I wouldn't want it to happen, and I wouldn't want banks to fail, but people have got to understand that you cannot be kept immune from all risk completely. And then you have consumers beginning to understand that risk and then beginning to to not kind of deposit their money with banks. Where, of course, you're an investor, you're part of the balance sheet, and that's the other thing people don't quite understand is when you put your money in a bank, you are a bit of the balance sheet, not somebody who's got a shoebox with your £50 note kept under the counter. So it's all of this kind of stuff which we need to educate people.
Can I just ask quickly, is it the formal position of the Conservative Party that it was a bonkers budget now?
I think it's the informal position of all of us who are left.
Sharon, you wanted to come in?
Well, I think that there's so many things you can learn about LDI. You can point to it and say there's a repetition of the mistakes that have happened in banking and other things before. But one of the mistakes that was happening there was that there was, if you like, regulatory interference in order to encourage pension funds to hold a lot of gilts at a time when the returns were very low, and then they had to try and find ways to increase the returns. And so then, although technically they're not allowed to borrow, they decided that it wasn't borrowing to do sort of repeated repoing, and therefore got themselves into this position that they didn't have enough liquid collateral to cope with the sort of event that happened as a result of the mini budget. But the lesson we have to learn from that is, we're now looking at pension funds and saying we want to some extent, mandate a little bit more about the kind of things that they're investing in, whether it's going to be UK infrastructure or whatever. And we have to be prepared for the downsides of that if we've got lots of bigger I know this goes on to your next session as well, but if you've got these bigger funds and you're going to have ways in which means they're going to look very similar in the types of things that they're investing in, then the risk of some kind of contagious effect happening and it all going the same way becomes higher. I'm not saying we shouldn't do it, but we have to take account of that fact.
Okay, so contagion still very much a possibility. Unfortunately, that is all we have time for, but thank you so much to all the panellists for a really interesting discussion, and hopefully we covered quite a broad stretch of financial stability issues. So the next panel is Unlocking Investment in the UK Economy, moderated by Fiona Maxwell, so do stick around, and thank you again for all of those points.
Thank you.
Hello everyone, welcome to our second panel discussion. We're going to jump from banking regulation to growth. My brain is full of Basel now, so I'm going to try and move on. But really delighted to welcome a really impressive team here to discuss growth and what that means for the UK. I will, without further ado, introduce my lineup of speakers. To my left, Liam Byrne, MP, and the chair of the Business and Trade Select Committee. Next to him, we've got Louise Hellam, chief economist. Oh, sorry. You swapped. Sorry, we've got, I'll start at the end over there. Wyndham North, Projects Managing Director, Growth Fund of the British Business Bank. And we've got Louise Hellam, Chief Economist at the CBI, then Daisy Cooper, Liberal Democrat spokesperson for the Treasury and MP. Right, Liam, let's start with you. I think we can't ignore the Trump-sized elephant in the room. We're here to discuss growth. We're here to discuss the latest that the Labour Party has been announcing on growth and economic policies. But, one thing you've said is potentially a 10 to 20% tariff on goods would be a doomsday scenario for the UK economy. You've called for the UK to toughen rules on Chinese investment and export controls. Meanwhile, the Labour Party is pursuing closer ties with China. So do you think your party is kind of taking the wrong approach in that regard?
No, I mean, I think the growth strategy's got like 4 or 5 elements. So the basic ingredients to growth, people, ideas and money, plus investment in infrastructure with a bunch of supply side reforms to make building stuff easier. And then that 5th component is markets. And I think, for some time now, we have moved beyond the era of American hyperpower and hyperglobalization. We're now into a very different geopolitical settlement. And this moment was always going to come, by the way. So, maybe President Trump has accelerated it, but we were always going to get to this point. And so what the UK's got to do now is basically construct this grand bargain where we draw closer to our defence allies. So with the United States, the case that we've got to win is that, look, higher duties means weaker defence. In fact, we've just run this calculation this morning. If you implement 20% tariffs on the UK, that basically offsets your increase in defence spending. So we think that increasing tariffs to 20%, that impact on economic growth probably knocks up to 2 billion off defence spending by 2030, because if you're spending 2.5% of GDP and your GDP is smaller, your defence spending is going to be lower. So there's actually quite a straightforward case to win with President Trump that, if we want stronger defences, then lay off the tariffs. That shouldn't preclude actually the space that we've got to draw closer to Europe. I mean, the cage of red lines that we've got, some of us may not agree with it. I think Daisy and I probably are on the same page with this. But nonetheless, there's still quite a lot to go out there. So an SPS deal on agriculture and agri-foods, for example, that can probably add about 3 billion to GDP in sort of fairly quick time. And then on China, you've got to remember that we're growing exports to China at about 13% a year and have been for a long time. And so what is needed is both a secure and predictable framework. So, I've argued that we need much stronger guardrails around economic security, investment security, export security, which my committee oversees. We need much stronger rules around forced labour. We don't have the equivalent of a Uyghur Forced Labour Act in this country because the pledge that Theresa May made to follow through on modern supply chain security was not implemented. I think Labour should be pursuing that. And then third, we need to get a lot tougher on carbon and just importing our carbon from China. CBAM will deal with that to an extent. It would be a stronger regime if we joined up with the Europeans on this. So I actually think that it's possible for the UK to land in a bit of a sweet spot between the US, Europe and China, but it is going to require us to rethink trade strategy quite quickly.
Okay, that's really interesting. I would love to come back to you on that, and I will, but I'll just get through the other panellists first. So, Daisy, what is the Lib Dem view on this? Do you think we should be moving closer to potentially a US trade deal? Should we be prioritising trade with the EU? And, what's your view of, Labour's been in power now for about 4 months. Are they kind of striking the right approach to growth?
3 easy questions to start with. So let's start with Trump. I think in terms of his impact, it's too early to tell. He's very unpredictable, so is his administration. And the first time round, he said a lot of things and didn't always act on them. So I think we genuinely don't know what's going to happen. We have to be open to a trade deal, but we have to be open to it with our eyes open as well. I think doing a trade deal with the States is very much David and Goliath. And we need to see what the demands on us would be. And they could be quite different. Some things around defence spending, there could be something around farming, there could be something about data privacy and who is allowed to run the internet, for example. So there's a lot of big questions that we just don't know yet what's going to be on the table. So that's a kind of a bit of a watching brief, I think, for now. In terms of what Labour has done, it's very much my view that they've put all of the growth eggs in the building stuff basket, right? They want to build a lot of houses, they want a lot of infrastructure, and there are sort of good reasons for doing that. I think if Trump does come in and quickly does put tariffs in place, that will have a knock-on impact for the cost of materials for construction, and that will then hamper what the government is trying to achieve. So I think there are big risks there. From our point of view, we think there are lots of things the government could be doing to improve growth, whether that's investing in skills, whether that's unleashing small businesses and completely overhauling the business rate system, something which we've been quite critical about in the last few days in particular, but also the last few weeks. And definitely getting a better deal with Europe as well. So we have to remember Europe is our largest market. We have to make that deal work better. We know businesses are wrapped up in red tape, and that should be our #1 priority right now as a country.
Okay, great. Louise, let's move on to you. You're here to represent the UK business view. I'd be really interested to know, you had your annual conference last week. Reeve spoke, she said, we probably won't have another tax rising budget again. Did you feel that was enough kind of comfort hearing that at your conference? And do you also have a view from kind of the business perspective on whether we need to be looking more towards the US or more towards the EU, or indeed both, for kind of businesses to succeed in the country?
Yeah, no, definitely. I mean, I think it definitely feels like last week, but yeah, actually it was only Monday and we had Rachel Rachel come along and speak.
This week?
It was this week. Okay. Yeah, I know. It's only like 2 days ago, but it's been quite busy. But yeah, I mean, I think firstly, I mean, it was really great to have Rachel there, and I think it was really important for her to come and speak to the business community, particularly after the budget. And I think that we are very much behind the mission of the government at the moment in terms of promoting growth and investment in the UK. But I think actually, if you're looking at the budget in isolation, the feeling from many of our members, and it is a very strong feeling, is that the budget has made it much more difficult for businesses, particularly when they're thinking about hiring and investing. And that has had real impacts in terms of the decisions that businesses need to make, particularly when they're thinking about their budgets for next year in terms of how many people can they afford to hire, what kind of wage settlements they can give to people, and actually where some people are having to think about, whether they need to restructure their workforce or reduce investment. And I think that that confidence around the strategy for growth and investment has taken a bit of a hit because of that. So I think, we are very much feeding in those messages to government and talking to the Treasury about what is possible to try and restore that confidence. But I think what we definitely need to do is we need to make sure there is a much clearer strategy for growth going forwards, thinking about how we are going to make sure that we're getting investment going. Rachel Reeves made some really great announcements as part of the budget that I don't think we should forget, particularly in terms of that commitment to greater capital spending going forwards. So I think it's about making sure we've got a clear plan of where that investment is going to take place, how that can help crowd in a bit more confidence and a bit more investment from the private sector. But it has made things more difficult, and I think that when we're talking about what the external economic environment might look like going forwards as well. I think, again, the budget is coming ahead of some of those concerns about what tariffs could mean for the UK kind of business community as well. So it's, again, where it feels like both that domestic and that international environment has just become a little bit more difficult.
And Wyndham, from your perspective, British Business Bank wants to scale up homegrown companies. We need kind of confidence. We need, as Louise was saying, confidence around growth in the UK. From your perspective, do you think that is taking a hit by kind of the geopolitical conditions? And was the budget kind of a confidence building event for you?
I think there are always going to be challenges for businesses looking to scale up, but we should remember that the UK is incredibly strong already. So we're fourth globally in terms of creating unicorns. Third strongest venture capital market in the world, 3 of the top 10 universities in the world. And the opportunity to invest in those companies is enormous. And I think what's exciting about it is actually that there's also such untapped potential. So one of the things we're really focused on is, actually I heard your last panel talking about it, is how do you unlock more pension fund investment into this part of the market? Because actually, we have this incredibly strong seed and early stage investment pipeline, but we're not so good at converting that into the big scale-up companies, and many of them end up in the US or overseas. So if we can retain more of that in the UK, that creates jobs, creates innovation, and it's good for the economy overall.
And Louise, we kind of spoke about this before. If we want to kind of scale up companies here, one of the big things that needs promoting is the listing environment. We do see headlines of companies like Klarna very recently suggesting it might initially have listed in London and then actually heading to the US. What feedback are you getting from members about whether the UK is the best place to invest, or whether actually once you scale up it's kind of time to move abroad? Yeah, so we see that as a big issue in the UK at the moment, and it's a really big concern of our members, particularly those who are already in the FTSE, but also those looking to expand and grow as well. So actually we've set up just over the last couple of months a special project to look at this, and we've got 25 of our kind of biggest CEO members to look at and actually kind of myth bust a little bit of some of the issues in the UK market. So we've been doing a deep dive on that at the moment. I think one of the issues that a lot of people talk about is the valuation between the UK market and the US. I think that is definitely a concern, but there is to some extent that some of those really large US companies are perhaps skewing some of the kind of data on this. So I think it is an issue, but maybe less of an issue than people sometimes focus on. Okay. But what has been really interesting is actually the types of investors in the UK market is often quite fragmented. So in the UK, we've got a lot of investment that is held by multiple kind of small stakes people. So actually what happens when we're talking to UK companies is, have they got the confidence of investors to make really long-term decisions, and perhaps ones that, you really need to have that good discussion between boardrooms and investors to understand the investment strategies, perhaps might involve taking a bit more risk. But where I don't think we're as good in the UK about making some of those really big long-term investments. So I think there is a bit around, what is the right regulation in the UK, and have we got that in the right space? But it's also a bit of a kind of cultural discussion as well. And I think those things are sometimes the things that are a lot harder to shift, but it is a big focus for us. So we're doing a lot of that kind of analysis at the moment, and we're looking to come out with some policy recommendations next year. But yeah, particularly within our CEO community, it's something they've actually said we really want
to come together. And so within the CBR, we've created a group specifically to do that, because I think it's a really big issue in the UK at the moment.
Yeah, I've noticed you nodding along, so I'd love to hear your thoughts.
Yeah, so I think that as part of the issues with listings, some of it is external and out of our control, and some of it is within our control. So Louise has touched on the valuations issue. And I think with Silicon Valley and other things like that, they've got more expertise, and that's why perhaps some of the valuations, that might be one of the elements why valuations are different. I think the issues here in the UK is we're very good at startups, but it's the scale up that's the problem. And a lot of small companies that then try to scale up, part of that journey is getting a government contract or a contract with a local authority. And I've had this conversation with a number of medtech companies. We've got a very fragmented government system here. So if you've got a fantastic medtech product and you want to roll it out, you can't just speak to the NHS. You have to speak to 40 different integrated care boards. They don't have a harmonised process for bidding or for procurement. And central government doesn't often look at buying things from smaller startups or scale-up. So there's a real problem there, I think, from government's point of view. And sometimes I think that when they do get those government contracts, there can be problems with the licences. So if there's intellectual property and the government retains the licence on the intellectual property and then tries to sub-license and then sort of sub that out to other competitors, you don't really want to share that information. You don't want to share your IP with the government. So I think there are things that the government could do to become more friendly, to make it more likely that people will scale up here. But there are some external issues as well.
And Liam, as the Labour Party representative here, do you hear that there are changes perhaps the government needs to make in order to help companies scale up better?
I don't know about that, but if you look back, there are two problems here, right? So one is market size and the other is liquidity size. So if you look back to one of the last truly global companies that has been created from scratch in this country is Arm. And I wrote a book a few years ago called Dragons, which is a story of our economic history through 10 great entrepreneurs. And one of the really striking things is that we are a country that is built by extraordinary entrepreneurs who made history by inventing the future. But we haven't had that kind of abundance of great global entrepreneurs since the war that perhaps we have over the past centuries. Arm is an exception, but when you talk to the founders of Arm, they set it out to be a global company from the very beginning. And of course, what that meant is that they were setting up from the beginning supplies, businesses, marketing operations in big markets. And the UK is a small market. And that's why, Daisy's right to kind of underline the point about tighter integration with Europe. It's kind of next door. It's really big. Okay, it's not growing super fast, but it is growing.
Yeah.
And it's going to get bigger as expansion drives out to the east. So, the UK has got to create that kind of bigger global trading environment, and we've got to be a place from which you can build businesses globally. But second, the truth is that the London Stock Exchange just doesn't have the depth of liquidity that the New York Stock Exchange now has. And, it's in a kind of a pickle in a way, because the scale of liquidity in New York now means that they're able to build just stovepipes of technical excellence that are driving better assessments of valuation than I fear we have available in London, which is why you have on the investor side, you've got to consolidate this kind of crazy 3,500 different pension funds into a much tighter, smaller handful of super funds like Canada, like Australia, that are just better able to be intelligent stewards. At the moment, we've got a lot of funds. They follow market, but modern portfolio theory. They're putting eggs in all sorts of baskets, and they're not looking after the eggs. And so you've got a problem of increasingly blind stewards and captains in boardrooms who aren't necessarily focused on the long term. They're too focused on the short term. So we've got to shift our entrepreneurial environment onto a new equilibrium, bigger markets into which to sell, and a bigger investment market from which you draw the liquidity.
Okay, yeah, and this refers to Rachel Reeves' kind of landmark Mansion House announcement, which was to consolidate all these pensions to create these mega funds, like you say, to kind of to mirror what Australia and what Canada are doing. Wyndham, I'm curious to hear from you what that kind of looks like as an investor. Is that, does that really kind of help, again, companies to receive more funding, to help grow the economy?
Yeah, I mean, to build on the point that Liam was making, actually, I think that although
you can trace a lot of the challenges in the listing market in the UK to the listing regime itself, but there's also the stage before that, which is the scale-up end of the private markets. And if you're not getting the UK investment in at that stage, if you're getting a table of international investors who are then guiding that company and saying, actually, you should list in New York, or we'll keep you private in the US, that's where you also get that drag away from the UK. And to your question, consolidation will be undoubtedly kind of important because it gives the pension funds that scale to make those investments. But I think the government also recognises that by itself it's not going to be the answer. And we've spoken, I mean, the work that we're doing is to set up an investment vehicle to try and catalyse pension fund investment into UK companies. We've spoken to dozens of pension funds over the last year, and you hear the challenges are beyond just scale. It's about the fee dynamics and regulations, and so you need a holistic solution. But if you can get it right, and it's really a perfect match because you've got long-term investors who can wait for value, but also who have an interest in the sort of society they retire into. And so if you are backing companies that are doing great research around cancer treatments or using AI to solve challenges around, I don't know, financial crime, whatever it is, it's such a win-win for pension savers as well. So it's exciting as well as challenging.
Okay, and you mentioned some potential regulatory barriers there. Is there anything you would cite in particular?
Without going sort of too deep down the regulatory rabbit hole, I mean, there are sort of challenges around the fiduciary duties that trustees have on pension, for pension funds, where what can they take into account in making decisions. There's challenges particularly around, and the government's actually made progress on this, but around sort of the charges that you can play into it. Again, you can solve those, but if the culture, I mean, actually Louise was saying, if the culture doesn't change as well, and you've got basically a race to the bottom on fees, then that's what you need to address. You need to be willing to pay. Venture capital is an expensive asset class. You're sourcing deals, you're sitting on boards, you're helping companies grow. But the returns can be really worth it, both in pure financial terms and in wider benefits. And recognising that in the regulations, but also culturally, I think is how you start to unlock that. And we're seeing some movement now. I mean, we saw at the budget, the Chancellor announced we've received statements from Aegon UK and from NatWest Cushion, who are working with us on the launch of our product and who, with a view to making an investment, we're backing, we're investing in work that Phoenix and Schroders are doing. So you are seeing progress now, but it's how do you unlock that? I mean, there are £1 trillion in DC and LGPS pensions alone in the UK. It's a huge pool of capital that can be unlocked.
Louise, I'd love to hear your view on that from kind of a company perspective. What more needs to be done?
Yeah, I mean, I just agree with what Wyndham said, really. I mean, I think that all of this needs to be done quite thoughtfully, but I think everybody can see the potential prize on this if you get it right, and particularly where, there is a lot of assets in some of those pension funds, and we know that within the UK we need that investment. So it is exactly as you said about making sure, how can we make sure this is a win-win and kind of you're bringing prosperity to all of the UK as well. So I think, we're really keen to continue working with the government and working with British Business Bank, make sure businesses are feeding into that conversation. But if we can get this right, then it should be really beneficial and help to really deepen that capital pool that we need in the UK.
Daisy, do you have some comments?
Yeah, sure. I find this really curious. I think a lot of people say they're very frustrated that pensions aren't investing in British projects. And then you say, well, do you think the pension funds are run badly? And they say, no, they're run incredibly well and we're getting good returns, they're good projects. So it then raises the question, well, why aren't pension funds investing in Britain? So it's a different kind of way of coming at the question. And I think there's sort of two reasons for this. One is that actually there hasn't been a long-term industrial strategy setting out long-term infrastructure projects that pension funds can invest in. And I think when the government comes out with its strategy in sort of springtime, as we expect, hopefully that will unlock some of the opportunities for investment. And I think the move towards super funds, generally on the whole, welcome. I'm struck by the fact that the question the debate seems to be about whether we should be accepting more risk or whether we should have less risk, and not about who carries the risk and how we can de-risk. And I think, if you are, for example, a woman over 50 and you're one of the 25% of women over 50 whose entire pension pot is £5,000, then you don't want to have more risk around your pension. And I think when you look at other countries, not only have they had scale in terms of the pension, but they've de-risked some of the pension by providing a bit of a backstop, particularly for some of the smaller pensions. So I think it's important we don't talk about just the level of risk, but also who is holding that risk as well.
Yeah, really interesting point. And you mentioned at the beginning, you know, questions around why UK pension funds or pension funds aren't investing in the UK directly. And, you know, Pensions Minister Emma Reynolds is undertaking this review at the moment, and that there has been quite a lot of discussion about whether there should be a mandate for pension funds to invest in the UK. You know, the companies, unsurprisingly, are pushing back on that. They don't want to be told where to invest. They say that, you know, where they invest is best for their savers, and, you know, just because that's in the UK doesn't necessarily mean it's the right option. Do you think there should be a mandate?
Ah, goodness. So, it's a classic kind of yes and no kind of answer.
Okay.
So, I think fundamentally people want pensions to get people want what's that? Oh, steady on, you're the one doing the cross-party working. So I think fundamentally people want a good return on their pensions. And if they're being mandated to invest in something that they think is not going to give them a good return, or something that is more risky, then obviously they're not going to like that. So I think you have to be able to, you have to use sticks and carrots. On the other hand, we do need to incentivise people to invest in Britain. I would much rather that we use incentives first before mandating. But fundamentally, you know, if a pension's getting pensions advice, and the pensions advice is don't invest in this project, don't invest in this country, well, actually, pensions aren't going to do anything differently unless that advice changes. So I'd rather we had incentives first, and we had the right sort of architecture around investment, that there were really good opportunities. I think, you know, mandation is something that you can do as part of the package, but fundamentally you want to incentivise it so people are getting a good return. Reducing people's return on their pensions just so that you can invest seems to me to not be achieving the overall end.
Yeah.
But I think the debate on the mandate has got to go wider than this. I agree with a lot of what Daisy says, but the, you know, right of the 2 trillion that we collectively invest in pension assets, very few people in this room know whether you're investing in companies that are poisoning the planet, dodging their taxes, or screwing their workers. And you know, one of the opportunities that we get through consolidating these funds is that we can have a new debate now about how we create transparency from pension savers through to what funds are investing in, which is why the point about fiduciary duty is so critically important. And Nest in particular have just pioneered some really good advances in stewardship codes. Good Business Charter, you know, is another organisation that has actually set out, you know, just here are 10 things which good companies should be doing. And the research that we've done with the All-Party Group on inclusive growth shows that 2/3 of pension savers would accept a slightly lower return if they were actually confident, if they had the confidence that they were investing in virtue and not vice.
Okay.
And so, you know, if you think about what's happening next year, we've got a pensions bill that's going to help consolidate funds, and we've got the corporate governance and audit reform bill that is coming too. There is actually the opportunity to put the UK capitalism on a different equilibrium that looks much more like a civic capitalism, where you've got investors who are doing the right thing and where you've got boards that are doing the right thing. And that's a really exciting opportunity that is remarkably under-debated at the moment.
Well, does anyone want to come in on that? I've got some questions flooding in on Slido, but does anyone want to come in on that before I...
Well, I think just briefly, just in terms of the mandation points, I mean, I think similar to what's said, I don't think that is something that we would support. It's more that bigger challenge, actually, of thinking about, well, if this investment isn't coming to the UK, why is that? And about actually uplifting the level of growth and particularly productivity that is happening in the UK. And I think that is obviously the big prize when you're kind of stepping back and looking at the bigger picture on this. And I think where all of these issues are really important, but actually it's about that collective. So it's everything that we're doing in terms of the financial services. How does that piece fit into the wider industrial strategy, fits into the wider growth strategy? And I think that's where we are seeing a lot of these discussions now happening in the UK, and I think hopefully a lot of policy that is coming down the line. But these are all very complex things, right? So it's about, have we got the right groups of people who are feeding into these conversations? Are we mapping them out so people are clear on that bigger kind of vision and strategy? And again, particularly from the business perspective, then they have got that confidence that some of these reforms, especially if they are longer term, that they are coming down the track, and you're kind of telling people that story and that narrative around how we have got a greater vision for growth and investment in the UK.
Just to add a tiny little coda on that, I think there's a much bigger piece about how you democratise these decisions as well. I think on an individual level, we're so used to having everything on our phone. We move money around into different accounts, you know, for different sort of interest rates and things. But actually, very few people engage with their pensions. And I think many people, if you gave somebody the ability to say, actually, I would like to invest in upgrading my local railway line, and I'm prepared to take a lower level to do that, because I can see that there's a benefit to my community. Yes, I want to invest some of my pension in high street regeneration. Actually, there is a much bigger question about how we democratise the use of pensions and investment funds as well.
And the Chileans gave us a good model. I mean, you know, when the Chilean pension fund reform came through, it was much clearer to be able to invest in high risk, medium risk and low risk. You could kind of choose that sort of ABC-like options. And actually, you know, we should be trying to create similar kind of frameworks to just simplify how you can invest in virtue rather than vice. Because actually the returns across the piece wouldn't be that much different.
Yeah, and I think it also shouldn't come down to a question of do you want to have returns or do you want to invest in the UK and make good investments. I mean, if you look back over the last, I don't know, 5 years, actually, if you're able to tap into the best investment opportunities in, let's say, venture capital, those returns, looking backwards, I should emphasise, and without making financial promotions, they would outstrip, you know, other listed asset classes, infrastructure, even private equity. So if you can get it right, you can drive returns that justify the investment, even aside from the societal or wider benefits or economic benefits to the UK. But to your point, Daisy, as well about risk, this has got to be part of a balanced portfolio at any point, and it has to be a choice that you make depending on your stage of life and how far you are from retirement. You're absolutely right that you don't want people, you know, 10 years out putting all their money into higher risk assets. But if it's longer term, diversified at scale, then it can be a really sensible way to go forward.
And we shouldn't forget what's about to happen with auto-enrolment. I mean, you know, the fact that we have so many, 16 million pension savers now. Yeah. You know, when you just do a simple model of how much is going to go into that pension savings market, put a traditional glide path on it, you can see there's potentially £500 billion that is going to go into equity investment over the next 5 to 10 years. That is a really significant lever to help put our economy on a better growth path for the future.
Right, I'm going to take some questions from Slido, and just a reminder to everyone, please feel free to get more in. We've got quite a lot already. I'm going to go for the one that's been sitting here the longest, from Vincenzo at WPI Strategy. Taking the global landscape that Liam set out, what is the most attractive pitch of the UK around the world, given we're seen as a mid-sized market sitting between two huge markets? That's not an easy one. Do you want to take that?
No, I think it's pretty straightforward, actually. So, you know, one, we have some of the best universities in the world. Secondly, you know, we are just one of the greatest places to invent and innovate. You know, this is a country that's been burying its scientists with its sovereigns since we buried Isaac Newton. So this is a great place to innovate, and it's underpinned by a pretty substantial pool of long-term savings, and it has got access to global markets, and it's, you know, dare I say, it's got a politics that is not quite as volatile as politics elsewhere. Now, that does require us actually to fix this yawning inequality of wealth that bedevils our country, because that is a license for populism in the future. But, you know, right now, I think we would say that the centre ground of politics is kind of held at the moment. We haven't got the kind of problems that you're seeing in France, potentially with the rise of the AfD in Germany, nor necessarily the political outcomes we've just seen in the United States. So.
Well, sticking with the US, I mean, I do have to ask, because we haven't specifically touched on things like trade deals, but, you know, referencing this question, is that something we need to prioritise with the US and with the EU? And, you know, would we have to compromise on things like agricultural standards, particularly if we were to push for kind of a US trade deal?
So so President Trump likes the UK and he likes doing deals. And so, you know, the opportunity for a trade deal with the UK has gone up. When you talk to people in Congress, however, and Congress is important for trade deals, they're not interested in a sector-by-sector deal. They're interested in a grand bargain because they've got agricultural interests to put forward. That will be supremely difficult for the UK. And if you think the farmers' protests that we've had last week were tricky, that's like a teddy bear's picnic compared to what would be the case if we had a trade deal on agriculture, because our market would be flooded with hormone-fed beef and chlorinated chicken that would all be at a dramatic lower cost. That would be really challenging, I think, which is why Rishi Sunak didn't pursue it, by the way. And so I think there are things that we can do, around economic security, around defence investment, around digital, potentially around financial services. But the reality is that trade between the US and the UK is pretty friction-free at the moment. And when I took the Select Committee to Washington and New York in the summer, actually the big message from the business community, if you don't mind my language, was just, can you just please not fuck this up? Just because actually it's kind of going okay at the moment. Right. Just please don't be terribly disruptive. So, we've got to make sure that we avoid tariffs. We've got to, keep making progress in terms of trade closeness to each other. But actually, a free trade deal doesn't give you a gigantic new advantage that we don't have today.
Okay.
Whereas closer ties with Europe definitely do, particularly for Daisy's point about smaller investors who have taken a real hammering. And for those who have not seen Johnny Reynolds' evidence to the committee on Tuesday, it's worth looking at what he said about his goals for the trade strategy, because one of the big things that he does want to commit to is a growing number of smaller exporters. Most of those exporters are exporters to Europe, would be my guess.
Yep. Yeah. Louise, is that the message from your business community as well? Don't things are going well, don't screw it up.
Yeah, I mean, I definitely, in terms of what we're talking to them about, it's a lot more of just concerns about some of the ways in which some of those risks could increase, particularly when you're thinking about tariffs and trade and things like that. Actually, in terms of deepening some of the opportunities, I think, US is an important market, but to Liam's point, it's actually looking more towards the EU. And I think there's a lot of people that have got in their minds that we've got the renegotiation of the trade cooperation agreement coming up in 2026. So a lot of discussions over the next year about what could be the kind of opportunities there in the next phase of that. So I think in terms of if you're looking for opportunities, that is something that hopefully is on the horizon. And I think, again, particularly at this point on, we have seen a big fall off in exports, particularly for smaller companies in the UK. So actually, if we can give them, again, confidence and make it easier for them to think about increasing their exports, and we know, again, that's great for making sure that we have got competitive businesses in the UK, that, again, they're thinking about raising their game in terms of productivity and things as well. I think that is an area that, many businesses in the UK are really interested in.
One small sort of political observation, which I think often goes overlooked, is that we're going to have the same government in Britain for the same duration of Trump's presidency. And we can't overlook that, because that actually gives us some stability. So whatever you think of the government, whatever your politics are, that does give us a level of stability, which I think is a good thing.
Really interesting point. Right, I'll take another question from the floor, and hands up who wants to answer this. But what sectors does the Labour government view as priorities to power UK exports to China, and what will it do to support them? I don't want to pick on you, Liam, but I think I'll have to.
Well, the sectors where we have comparative advantages are listed out in the industrial strategy, and there's a lively debate going on as to whether that is the right focus for industrial strategy. So basically, there are kind of three questions with industrial strategy. So, one, have we got the sectors that have been picked in the right way? Two, what do you do about diffusing productivity gains throughout the economy? So it was actually Rain's point on Monday about, do you pick races rather than pick sectors? And third, we used to talk a lot about the everyday economy, which is the non-domestically traded, where productivity growth is low, but they're systemically important employers. You can't raise wages unless you raise productivity. How do you do that? So there are some big questions there. But the kind of sectors that were listed there are kind of the priority sectors for exports to China. So financial services, advanced manufacturing. Those are big growth markets in China. The third plenum met over the summer. We've had the return of language around reform and opening up. Chinese policymakers tell a good story now about their goal of creating a market economy. They're sending new positive vibes about their appetite for deeper market investment from sophisticated market leaders. I think actually most European firms and most Western chambers of commerce in China will tell you the reality is a long way different from that rhetoric. So the rhetoric reality gap is pretty significant. But it is just remarkable when you look at what has happened to exports to China. I mean, generally speaking, when the political environment gets worse, trade growth goes up.
Right.
It's a fairly persistent sort of 12 to 13% a year growth in exports at the moment. But if you're to make that trade more predictable in the future, my argument is you've just got to put stronger guardrails around economic security, labour standards and carbon.
Okay. Anyone else want to come in on that before I grab another question from the floor?
And my only observation would be that, I mean, during coalition years, Vince Cable set out, I think, about sort of 9 to 11 areas, and they were really quite similar to the ones that the Labour government have now outlined in theirs.
Vince had a lot of
and they were all high growth areas, and at the time that was really broadly welcomed. So, I mean, there seems to be quite a lot of overlap in that area. Some of the areas are slightly different, but broadly speaking, they were.
And actually, Greg Clark, to be fair to him, listed a pretty similar set of sectors. So I think,
Yeah, so I think it's really positive that we've got an industrial strategy now, and I think, like you say, I think even before it was written, you got a relative amount of predictability about what some of those sectors are. So it's now about really making sure, can we set out what is the detail behind that, and really working with businesses in those industries to make sure we have got really clear kind of strategies, we've got the right kind of capital arrangements around them, etc., to make sure that they can invest. But I think importantly, to Liam's point as well, is that whilst you see the possibilities for those sectors, we're not leaving everybody else behind, right? And you're thinking about actually how do you create the right environment in the UK for every type of business? And that's where, you're thinking about you've got the right regulatory environment. And again, really great messages from Keir about thinking about how we make sure that can lean into more innovation in that space. You're getting the right tax framework. And, we touched on some of the perhaps challenges in the budget, but actually setting out the corporation tax roadmap again, very positive for many businesses in that space as well. So I think it's important to definitely focus on those sectors, but think about how we're making it easy for every business across the UK as well.
And there's a really interesting question here that I'd like to get to. So given the evidence, this is from Simon Ewell, given the evidence showing that beyond a certain point, financial services growth harms GDP, is there not a risk that the government strategy to grow financial services undermines its wider growth mission? This is a really interesting point because, the argument from the regulators, the PRA and the FCA, is that competitiveness equals good financial regulation. That if you lessen financial regulation too much, if you loosen it, you allow firms to grow exponentially, but actually it will end up costing more if there's another crisis or something like that. 100%. Anyone have any thoughts on that? I don't want to pick on anyone for this one.
Well, I mean, just having gone through the last financial crisis and then, having been the Chief Secretary, had to kind of clear it up afterwards. I mean, the key book here is Carmen Reinhart and Ken Rogoff. This time it's different. And, that makes kind of 2 important points that bear remembering. One, we've had about 40 financial crises since the Napoleonic War. We haven't graduated from a world where there are financial crises. And second, every period of financial crisis has been preceded by a period of financial deregulation. So you have to be incredibly careful about getting this balance right.
Just to add, I think there was a parliamentary commission on financial banking, or parliamentary commission on banking, which I think came to the conclusion that strong regulation actually improves economic growth because it provides the stability to attract more businesses to come here. So I think deregulation is not the way to go. There does need to be a conversation about smarter regulation and how you make sure that your regulators are properly resourced so they can make decisions quickly, so they have enough market expertise. And I think that's the conversation we need to be having, rather than whether it's more or less regulation. It's how do you get the right regulation and how do you resource the regulator to be strong and effective and quick and agile.
Yeah, I think I just really agree with that in terms of it really is about that focus on smart regulation, actually what the kind of outcomes-based regulation that you need to see. So I think that you need to make sure you've got that balance. And I think, again, hopefully that pitch from Rachel Reeves in Mansion House was right about actually thinking, can we take on perhaps a little bit more risk, think about how we can incentivise the innovation, but you need to make sure you've still got that right balance as well.
Okay, great. Well, we're almost out of time, so I'm just going to throw one more question to Wyndham. So should the government do more to link UK growth and investment in general with green UK growth and investment? So I wonder from your perspective whether enough is being done on kind of sustainable finance and investment. Is there enough of a focus on companies that are green, or growing to become green?
I think the government's doing a huge amount in that space, and the creation of a National Wealth Fund is a huge step there, which is, you know, we'll be investing in both infrastructure and green projects across the UK. And in many ways, they'll be doing what the British Business Bank has done for the last 10 years, which is to use that government capital and government balance sheet to leverage in private investment into those areas. And we've done that at a ratio of over 2.5 to 1, private to public. And we'll be supporting the National Wealth Fund to do the same. So I think the government's doing a lot in that space. We're also focused on the right sort of products to get access to finance on green issues. So always more to do, but I think there's a lot of focus on it as I see it at the moment.
Yeah, and I think just on that as well, I think that's in terms of thinking about where the UK can be a world leader, I think that's really where we're leading the charge on some of this thinking. So that's really positive to see.
Yeah. Just briefly, I mean, during coalition years, you know, we Liberal Democrats were key in setting up the Green Investment Bank. Unfortunately, that was scrapped. If it hadn't have been scrapped, maybe we'd be in a better position now with cheaper energy bills and more renewable energy. And so that's something that we were very proud of. But I think anything that the government can do in that space would be very welcome.
And setting up British Business Bank as well, which I've already thanked you.
Exactly. You're welcome.
Liam, do you want to have the last word before we finish?
No, I think it's all been said.
Okay, perfect. All right, well, I think we are now standing between you all and lunch, so I will just say thank you very much to the panellists. I think it's been a really, really interesting debate, and obviously there is a lot to watch out for in the coming weeks and months. So, yes, thank you. Please enjoy lunch, which is happening through there, and be back here for 2:30, where I will be interviewing Tulip Steek, City Minister. So thank you very much.
What I don't think you should do is have a financial system that is set up to extinguish risk.
And we're number one for international debt issuance. So yes, I guess we are going to attract some crime, and we do work to get that crime out.
What is your response to that? That yes, we want to keep people safe, but we also need to protect people's privacy online.
Welcome back, everyone. Hope you had a nice break over lunch. I'm delighted to be joined by City Minister Tulip Siddique. I was just going to say you've been in role since being Shadow City Minister and have continued. And I'm particularly delighted that I've just found out that this is the first live interview I believe you've done. So I feel honoured. Thank you so much for joining us. I mean, as this is the first live interview you've done, I mean, how have the past 3 to 4 months been? How has the journey from Shadow City Minister to City Minister gone?
It's been a massive leap, if you like. And I know it sounds like a really obvious thing to say. And people said it to me before as well. And I think I mentioned to you before when we were talking that I'm still quite friendly with the city ministers that came before me, which might be quite unusual for some politicians. But I think because the city role is quite apolitical in a sense, and it's more about financial regulation than trying to score political points, if you like. So I've stayed in touch with them, and all of them said to me before I became elected, I guess they saw the writing on the wall, so they knew I was probably going to become city minister, that you have no time to think. And that's exactly how it's felt over the last few months. Like, in opposition, you had more time to think. That's why I wrote the financing growth paper, because I had time to think. There's no way I could write that now, because I just moved from one thing to another. And so I guess it's the speed of things. It's also, there's so many things you want to get done, and obviously things take time. Whereas in opposition, you're saying it, you're not really executing it. So I guess that's been my experience, but it's also been absolutely amazing because we waited for 14 years, and I've been an MP for 10 years next year, all of it in opposition. So being in government, whole different experience.
Yes, and I'm not just saying this, but there has been a lot. I mean, we've certainly been busy as journalists over the last few months in the financial services sphere. So that obviously goes to show that a lot has been going on. And one thing I particularly like to chat about is Mansion House. So that was delivered by Chancellor Rachel Reeves a couple of weeks ago. I think one of the key messages for the city was this one of, renewed risk-taking, that perhaps the post-crisis regulations have gone a bit too far, that we should see a bit more, there's been unintended consequences. And obviously growth is such a big buzzword for the Labour Party. Is it possible to kind of achieve that growth and to take a bit more risk, encourage the regulators require the regulators to encourage firms and consumers to take more risk, but not kind of take a step back to 2008?
Okay, so we discussed this a lot, as you can imagine. Rachel and I and the Treasury team discussed this a lot before Mansion House. And we've been thinking about the global financial crisis, obviously, and Gordon Brown actually came into the Treasury a couple of weeks ago to talk to all of us, came back to his old office, and it was great. It was an amazing moment. But it really reminded us that things have moved on. Like, we are at the final stages in terms of, for example, Basel 3.1 feels like it's sort of the final step after the global financial crisis. COVID is over, hopefully. Things have settled down. There seems to be some sort of stability in the country. This is a time to reset the relationship we have in the city and to take some risk. We feel the risk appetite is just too kind of low in our country. So the Chancellor and I, what we are trying to say when we talk about increasing the risk appetite is that certain measures were taken which were the right measures at the time in the global financial crisis. And everyone did everything they could to save our economy and save the city. But we don't feel they're all necessary anymore. There's obviously got to be a balanced approach. Like, I'm not talking about a race to the bottom, sort of deregulation, let's just leave it all out there. This is about taking small risks which are responsible, sort of proportionate regulation. And I can give you a few examples of the ones that we discussed as well. But just to like really put it on the record, what we're trying to do is increase the risk appetite, increase responsible risk-taking to grow the economy, which is the central mission. And you journalists are sick of hearing us, right? The growth mission, that's what we keep talking about. You're sick of, someone was saying to me, it's Labour bingo. Everywhere we go, it's like investment, reform, growth. And I said, well, it's working. That means if you're repeating those back to me. But there's a few examples that we want to think about. Like, for example, the senior managers regime and the certification regime. There was a reason why it was put in. It was right for the time. But now we feel it's becoming a bit of a bureaucratic burden. And we feel like that's something we could look at and change and remove. Have you heard about this, like how we are an outlier in Europe when it comes to deferral pay schemes? And that's something the banks have brought up with me repeatedly. So if we can change that, then does that mean we attract more talent? Does it mean we're more competitive on the world stage? And then you would have heard me in Financing Growth, which you know well because I spoke to you about it, is looking at the FCA rulebook, which apparently, if it's printed out, is bigger than you and bigger than me, like in terms of height, because it's just so many pages in there.
Yeah.
I mean, can we look at those rules, strip out some of the rules which are duplicate, which we don't need anymore, overlap with consumer duty? Like, at what point can we start giving a bit more flexibility to the firms who want to operate in our city and our financial services? You might ask, I kind of anticipated, what happens when things go wrong, right? And the truth is, you can never have a system where nothing will ever go wrong. I mean, I would be very naive if I thought that. There's always going to be a time, but we've just got to be responsible about it and not take risk to the other side where there'll be, a huge collapse. So we've just got to be a bit responsible. But we do feel it has had unintended consequences. We think we're far enough from that now. We feel like we're entering a period of stability. This is the time to do it. So that's our thinking.
Okay, that's a really helpful answer. And you've pledged to kind of work closely with city firms. You described your approach to rulemaking as kind of co-design being a key word. Do you feel that firms can be trusted not to just push for kind of wholesale deregulation? Do you feel like you and your team and as well the government have kind of a good relationship with the private sector? You can trust them to not take things too far?
It's taken a very long time to build up that relationship. I'd be lying if I didn't say, I mean, all the stuff you read about the charm offences is true, right? We did do that. We did go out on a limb because we had a period in the Labour Party, as anyone in this room will know, where it didn't feel like we were very friendly with business. It didn't feel like it didn't feel like we wanted to speak to the city, and those years were difficult. Keir then came in, and Keir was absolutely certain right from day one, and as you say, I was Shadow City Minister then, and with the Shadow Chancellor, that we've got to build up this relationship. It's got to be open. And so Rachel and I started going and speaking to everyone we possibly could. Of course, people will put their interests first, but and talk to us about things. But what we've done is, I suppose, filtered the things that we feel. So if lots of people are telling you the same thing, that's the point where you think, okay, we've got to do something about this. Nearly everything that came in the Mansion House speech came from industry. For example, the Digital Guild, which you know about, we're calling it DIGIT, which is a very sexy acronym. But the Digital Guild and the thing we're working through, the Digital Security Sandbox, and trying to get this issuance done, came from industry. Like every person we spoke to, and whether that was UK finance and the trade bodies, or whether that was banks, whether it was anyone from the city, all the stakeholders were saying to us, something's got to be done on Digital Guild, something's got to be done on the sandboxes. And so we listened to them. So I guess, in answer to your question, we've been around long enough where we know that someone's telling us something that will just work in their favour and not in the city's favour. And then there's like everyone in the city telling you the same thing. And everyone in the city has complained to us about fraud, for example, which is a major topic. Everyone has said we've got to look at the National Payments Vision, which was done by Joe Garner. And another example of it being, this role being quite apolitical, that review was started by my predecessor, predecessor and the previous administration, but being delivered by us, because it's a genuinely good review about how we transform our payments landscape and the ecosystem and account-to-account transfer. So I guess we would listen to the industry if everyone was telling us the same thing. There have been some suggestions which you know, Rachel and I have been like, okay, that's your idea, but then we've tested it with other people and said no, and that's the idea of co-design.
Okay, that makes perfect sense. And speaking of things that the industry likes and dislikes, one of the, I would argue, probably most hated policy proposals out there at the moment is the FCA's bid to name firms that are under investigation. So people like to call that the name and shame plans. So this morning they put out their latest thinking, and the idea is that it goes ahead, but with some caveats. So firms have 10 days to say to the FCA, actually, we haven't done anything wrong, please don't name us. The FCA will take some more factors into account before naming those companies. The feedback we've got, even in the 3 hours since those proposals have been out, is that this hasn't gone far enough. Firms are still pretty upset. It would make the UK an outlier, supposedly. I know you have actually kind of spoken on this topic before. I wonder whether you think these changes are enough?
So when the proposals first came out, this name and shame, for a start, the narrative around it was really bad, right? And it didn't land well with industry. And I think the messaging around it was dreadful, and it worried people. It really worried people. And if there's anything we've learned for the last few years, is that you can't cause this sort of instability. And we want to give people the confidence to invest in our country if we want to deliver this central mission of growth. And these proposals didn't fill people with confidence, and they didn't feel they could be in this scheme. So I did raise it with the FCA a couple of times. It is a matter from them at the end of the day. They are the regulators. But Parliament holds the regulators to account. So I raised it with them several times. Industry told me repeatedly that they felt it was too hostile, that it wasn't done in the right way, reputationally could cause lots of damage. Industry also brought me cases where they didn't feel it was appropriately handled. So I have raised it with the FCA several times. They did, and obviously I meet regularly with them, as you can imagine. They did say they would look at it again. From the sounds of it, they have watered down some of the proposals. I guess it's now wait and see. Let's see how it goes from here. From what I did gather from the FCA and having the conversations, is that the number of firms per year is actually very low who get caught in this enforcement, just so you know. But what I will say, and I said this in opposition, I say this in government, just the messaging was really wrong in the way it was done. Like, we don't want people to operate in our financial services sector and be worried all the time. So, yeah, and the rulemaking, obviously, there's a lot, we know there's lots of rules that they have to abide by, lots of regulation, which is why we've asked for the rule book to be slimmed down. So we're aware of that.
Yeah. Okay, great. And then, I mean, kind of carrying on that theme, we can talk about the UK's position in the wider world. Labour Party has been very vocal about a Brexit reset, so resetting our relations with the EU. That, I mean, has been welcomed kind of across the board. But what specifically does that mean for the City of London, for financial services?
I should say right from the start, because I'm being interviewed by a journalist, we're not going back into the European Union, right? So just making it clear in case there's a headline somewhere, just because everyone knows how I voted and how I campaigned. So just to say, we're not going back in. However, we do really feel there's a need to not ramp up this divisive rhetoric, okay? And we do feel there's a real need to reset this relationship. They are our closest trading partners. We've got to have a good relationship with them if we want our financial services to grow. There's no question about that. So what I'm doing at the moment is, for a start, I met outgoing Commissioner McGuinness, had a very good constructive meeting with her. I will be meeting the new Commissioner Maria, who's coming in quite soon, to talk about shared interests and how do we make sure we do talk to each other. But I'm also doing a series of statutory instruments. Parliamentary time, it's quite hard to get parliamentary time to get a huge bill through, like the Financial Services and Markets Act. But you can do small legislative changes, which makes it easier. So some of the SIs I've done have been based around how do we get this relationship a bit smoother, have access to trade. And, it's about making sure it works for the EU as well as working for us as well. The Chancellor's also going, I think it's next month, to the meeting of the financial ministers for the Eurogroup, and she's going to that as well. But, if you think, not being facetious, but if you think about the last few people who are in charge of managing our relationship with the EU, it was Boris Johnson, and then Liz Truss, and then, I'm just saying, I do think Keir Starmer will do a better job, and I think I'll do a better job in trying to make sure we have this constructive relationship. So we just cannot ignore the EU, is our point, and we have to make sure that it works for us, works for them, but for financial services, absolutely crucial. So I won't bore you with the details of the SIs, but if anyone's interested, that's what we're trying to do, have some kind of back and forth in the most constructive way possible without having a huge bill go through Parliament.
Okay, I think if we had more time, I would definitely look to go through those, but maybe we can take that
audience,
offline. Yeah.
I don't know if everyone wants to hear about every SI I've done.
I mean, one not necessarily legislation, but kind of one policy approach that is interesting in relation to the EU is equivalence. Now, you know, since we left the EU, they've given the City of London, they've given financial services one area of equivalence. So that's for CCPs, for clearinghouses. That expires in June 2025. So, I mean, that'll come around very quickly. Will you be seeking in your conversations with the new Commissioner for Financial Services an extension of that?
I guess it's a matter for them at the end of the day, but I'll discuss it with her. Yeah, it's the truth of it. I will discuss it, but I don't know which way they're going. But there's no topic is off the table, really, when it comes to that. And I've got to speak to her generally about what does she see as the relationship going forward. Like Commissioner McGuinness was very clear that this had to be a stronger relationship than it had been in the past. I'm sure this new commissioner will have the same sort of attitude, but I don't know, it's the truth. So I have to meet with her and speak to her. But anything we can do to help this ebb and flow of the financial services sector and get us access to some of the things that we had access to when we were in the European Union, I'm going to try and get the best deal for our country, I suppose. So yeah, I'm also planning a visit to Brussels quite soon.
Okay.
To try and speak to everyone and remind them that we are a new government and we do want to have a good relationship with them.
Yeah, so do you feel kind of there are endless opportunities now that in the UK, Labour government's in power, and in the EU, we're about to have a new commission take place. So it's kind of, it's new on both sides of the channel.
I think there was so much sort of, the whole referendum became so toxic, didn't it? And then the fallout afterwards and some of the rhetoric that came out and the narrative that came out from the government, I do really think we need to put it behind us. There's no doubt about that. I think there is a chance for a reset in terms of relationship building. You've seen the Prime Minister go over there. You've seen, how he's made huge approaches. There's no doubt about that. I think there's time for a reset. But I also just go back to what I said. I think we are entering, thankfully, a period of stability just because of all the things we've gone through, like the war, COVID. It feels like the end of the global financial crisis, like I said. I mean, think about the number of prime ministers and chancellors we had, one after another. Think about the snap elections we had. Like, I fought 4 elections in 10 years. I mean, that's not normal, right? So just got into office straight away, another election. And the financial services sector keeps saying to me, look, the financial cycles don't operate in the same way as political cycles, and you've got to be aware of that. And they would sometimes say to me, I hope you're not going to get into office and then rip up all the work that we've done and rip up like the future regulatory framework and just rip up everything. And I said, no, of course we wouldn't do that. And they were like, we just don't know. So I think that's what we're trying to provide, some sort of stability in terms of, look, you can go about your job because otherwise we're not growing the economy, and it's desperately needed. One thing the Chancellor said to me constantly is that financial services cannot be seen in isolation. She said it's got to feed into the wider picture of growing the economy. So she holds me, she kind of does come and say to me, these are the metrics, have you met all of them? So we do have weekly bilats where she'll go through, have you delivered this, have you delivered that? So, I mean, yeah, it's... Yeah. Let's just say the night before I do prep for it. But
imagine.
She wants to make sure that anything we unlock the opportunity for is feeding into the overall narrative. So I guess in answer to your question, I do feel there is a reset. Yeah, there's an opportunity for a reset.
And I feel like I do have to ask, because obviously the UK is, the government is seeking to grow the economy. We heard this morning that, potential tariffs, if Trump does impose kind of across the board tariffs, that that could have a big hit on the UK economy. Is that something that the Treasury is thinking about very deeply as well? Obviously, the Department for Business and Trade thinking about this a lot, but is that something that could potentially undermine this new bid for growth?
So the Chancellor would rather we didn't have tariffs. She said it'll be expensive for people in this country and in the US, for all consumers. So it won't just be expensive for us, be expensive for them as well. She really does want, and we really do want, free trade agreement between the two countries. I guess it's a wait and watch situation at the moment. We will work very closely with the Trump administration. They're obviously a huge sort of investment partnership with us, exceeding $1 trillion, our partnership with them. So there's no doubt about not working with them. But I have to say, with the tariffs, we really want to concentrate on this free trade agreement that we have and operating. We want that with the whole country, not just with America. But yeah, I guess it's wait and watch now. But yeah. Let's see what they do. If you hear anything, let us know.
Oh, absolutely. We will. As soon as we hear anything, we'll be writing about it. We've got loads of questions come through, so I'm just going to take some of these. One thing actually that would be good to touch on is crypto. So I believe it was last week, but I keep getting my dates wrong, that you gave a speech on crypto saying that you will regulate for stablecoins and crypto at the same time next year. You'll provide kind of draft legislation on that. It would be great just to kind of get your vision on, where you think crypto is going. Does it need tougher regulation? Are you able to kind of strike that balance between allowing consumers to, trade if they want to, but also making sure that it's kind of done safely?
Yeah. So I think with crypto, there was a time when it was a small group of people using it. And what I've become more and more aware of is that there are people in the city who are using crypto, that's fine. But I am having, as a constituency MP, like young men from the South Kilburn estate saying to me, I've been trying to make some money. So the truth is, there's got to be some regulatory framework for all these activities that protects people from all walks of life who are using it. That's what's informed my thinking. So we've got to be very careful in terms of market abuse. I think that's one of the things. Fraud, obviously, there's like huge fraud here as well. You've seen from very famous cases in America, you could lose all your money, essentially. So for us as a government, is just trying to bring in some sort of moderation, some sort of regulation. There's some recommendations which were done last year, and they were around crypto assets and also stable coins. I know people have asked why we're doing it separately because they wanted us to legislate for stable coins earlier. I do think it's just more efficient to do it all together, but we will be legislating. Well, I guess I say legislating, providing a framework. That's what we would want to be doing. We have a consultation open at the moment, so people should be feeding into it. But I want to get this right. I feel like it's here to stay, and it got a much wider airing through the US elections than anyone thought. And people are more and more interested in it. It's become a topic of conversation, much more in my engagement than ever before. And I want to make sure we get it right in terms of the regulatory framework that we provide for it. So the consultation will finish, I'll see what the industry have to say, and then it'll be next year.
Okay. And I just want to ask very briefly about the regulators themselves. There's been a question here. The previous government handed significant policy-making powers to the FCA without significant enhanced scrutiny mechanisms. That's their wording, not mine. Will the new government continue with this approach or take back some power? And I'd like to ask that in the context of the national payments vision as well, because you mentioned that earlier. We've had a look through, noticed that some of the kind of previous powers that the PSR had are perhaps being handed to the FCA. Is that a vote of confidence in the FCA? Do you think it's really doing its job well after Brexit, or is it more that we need to kind of reduce what the PSR is up to, particularly after kind of controversy around the fraud reimbursement policy?
I think my response to that in terms of regulators, so let me start from what you said at the beginning. The regulators work for us, right? And Parliament has to hold them to account. And for me, I have been holding the regulators to account mostly on this competitive and growth objective, the secondary objective, which we backed when we were in opposition, and it is definitely the right thing to do. I don't think it's enough, let's put it this way, for them to just issue a letter once in a while to Parliament, which they've done, and they did put the metrics and how they're dealing with it and achieving the metrics fine. It's not enough. Basically, I'm not going to wait till next July to find out whether actually they're delivering on the secondary objective like I want them to, which is the fundamental thing right now. So there's a number of things. First of all, they've got to do the rule book thing that I've mentioned. We meet with them regularly and they have to tell me what the metrics are. We are doing things like reforming the FOS, the Financial Ombudsman Service. And one of the things I really want the FCA to do is clarify the relationship between the FOS and the FCA, because part of what you're describing in terms of regulatory congestion, which is one of the phrases people love using, is what's the role of the FCA? What are their rules and how do we interpret them and the clarity around it? And then the role of the FOS, right? So that's one of the things that we've got to do. In terms of PSR and APP fraud, there was obviously lots of conversations, as you saw, leading up to it. The latest report I had sounds like it's working according to plan, but I will keep tabs on that and find out how it's going. But in terms of the regulators, I'm not sure if the right question is, do they have too much power, blah, blah, blah. I think the question is, how do we simplify it and make the regulators work for industry? Because clearly at the moment, there are people saying that it's not working for them in terms of innovation, in terms of there's too many rules, there's not enough clarity, the name and shame, which you mentioned. There's obviously, and then lots of concerns that have been raised about people who've struggled. I understand all of that. And I think for me, my role at the moment is to make sure the regulators realise that they are concerns, they need to take them on board and they need to clarify their position.
Yes.
So I don't know if this means a whole host of people who've entered.
Yes, I think unfortunately we are out of time. It's been a really great chat. I just wondered if there's anything else you wanted to end on. Any policies that you feel you're particularly proud of that you're looking forward to enacting. Either at the start of 2025 or before the end of the year, just before we finish off.
I guess what I would say is that we're doing the industrial strategy, and I'm really pleased because one of the pillars that's been identified as an area for growth is financial services, and Rachel has been absolutely clear. This is not going to be me and civil servants sitting in a dark room in Treasury writing this financial services review, the first one we've ever had. It's got to be co-designed with industry. And some of the things I'm looking at, which, if anyone wants to feed in, the Women in Finance Charter, we've really tried to reinvigorate, is one of the things. We have Amanda Black chairing it, and we had a reception in number 11. So in terms of what do we do when it comes to increasing women in finance, but also economic abuses, which is another thing that I'm working on at the moment. In terms of our capital markets, we'll need another session to cover everything that's happening in capital markets, but how do we get people to IPO here?
Yes.
And Pisces, which is you've heard about Pisces, have you? Yeah, we're very proud of it. It's like the first time we've ever done anything like it, which in a controlled environment, private companies will be trading in intermittent windows. The digital guild, which I've already mentioned, but I'm just trying to look at everything that's been mentioned in Mansion House, but also the areas for growth. And we haven't even got onto banking and banking hubs and things like that, and getting people online. And then underpinning all of this is our huge financial inclusion strategy and our financial resilience and our pensions investment, trying to make people realise they can do more with their money. When we talk about risk-taking, people investing their money, we just don't have a culture of it. So how do we reset that when it comes to pensions, when it comes to people taking some risk with their money, but being confident that the system will reward them? So please feed in is my final say on the matter. The call for input is till the 12th of December, and then we start writing the strategy next year until spring.
Great. Well, that's a really good message to end on, and I can see why you say you don't have much time to think. So it sounds like there's quite a lot going on. Thank you so much for speaking with us. Thank you everyone for watching. And the next session will be moderated by Hannah and is on the city from abroad. So please do stick around. Thank you very much.
Thanks so much.
Thank you.
Yeah, whichever. Sounds good. Great, so welcome to this session on the city from abroad. My name's Hannah Brenton, I'm a senior finance reporter at Politico. Like on all the other panels, we'll be taking questions on Slido, so please do keep them coming. And I'm excited to be joined by a great panel to discuss the EU-UK relationship. So to my left is Chris Hayward, Policy Chairman of the City of London. John Ralline, Director of Infrastructure and Exchanges Supervision, Policy and Competition Markets at the Financial Conduct Authority. George Frieden, the Ambassador of Luxembourg to the UK and also long-serving Ambassador in Brussels as well. And William Wright, founder of the New Financial Think Tank. So on this panel, we're going to discuss the kind of future of the EU-UK relationship for financial services. We'll be taking stock of how things have changed since Britain's departure from the EU, but we'll also be looking forward to what might happen next amid the thawing of relations. And as we just heard from Minister Tulip Siddiq, Labour thinks there is an opportunity for a reset and a possibility to use that to help financial services to grow. We'll also be looking at what impact Donald Trump's return to the White House might mean for the EU-UK relationship as well. So just to kind of kick things off, if I can turn to you first, William, just in terms of setting the scene on where we are with Brexit. You've done a lot of work and research on this. What's really changed for the city since Britain's departure?
We have done a lot of work, and we very much hope never to do any more work ever again on the impact of Brexit. But I mean, I think the main thing that's changed in the last few years has been that as the Minister said, the relationship, as we all know, the political relationship between the UK and the EU has thawed. The tensions have thawed very significantly. It's very helpful to have had a Prime Minister, not just this one, but the previous Prime Minister, who is not lobbing insults across the channel at their counterparts, has been hugely helpful, and to have a period of relative political stability. In a financial services context, I mean, technical, close cooperation between UK supervisors, regulators, policymakers, and their EU counterparts is a fact of life regardless of Brexit, because the two markets are so closely interconnected. But what had previously been missing was the political permission to support and frame those discussions because of the political tensions around Brexit. And given the change in personnel on both sides, or changing personnel on both sides, and we had a very significant step forward with the Windsor Agreement unlocking the UK-EU Regulatory Forum, sort of formal structure for dialogue. The first few meetings, as I understand it, have been very much talks about talks and getting to know each other again. But that's an incredibly important step forward in building a closer relationship. But I would add that I think there is still a degree of lingering suspicion in parts of the EU about the UK's reform agenda. We can perhaps come on to this a little more later. There's what we call parallel divergence, both sides looking at similar issues, diagnosing the same problem, coming to similar solutions, but on a slightly different direction. But in some areas, and recently the changes, for example, to the bonus cap and clawback, there are still pockets within the EU that retain this sort of residual suspicion that Brexit was first and foremost a deregulatory project, and that the UK wants to deregulate and create an unfair competitive advantage just off the coast of the EU. And I think given that suspicion, I think there is still a lot of work to do despite these very positive baby steps, early steps in the right direction.
But has there been pain in the city, do you think? Since have you found that there's been less of an impact than you were expecting, or how would you describe the years until now?
I mean, the concrete impact has perhaps been less than some of the worst forecasts. I mean, our own work suggests that roughly 500 firms in the UK, based in the UK, have moved something somewhere to the EU in response to Brexit. Measuring job moves is a rabbit hole, a very dangerous one to go down. And it's clear that that what has had to move has moved. And from now on, I think the issue is really going to be one of the UK seeking to ensure that discretionary moves, so an investment bank or an asset manager, doesn't sort of decide next time they're thinking about where to expand their European operations. The UK will be keen to ensure that those discretionary investments and relocation decisions fall in favour of the UK, and equally the EU will be keen to ensure the opposite. But I do think, it sounds like a bit of a cop-out, but I do think it is genuinely too early to tell what the long-term impact has been. What's clear so far, I think, one thing that is clear so far is that if you think of it in terms of rest of world business, so business that derives from, involves non-EU, non-European, non-EU 28 customers and counterparties, that hasn't really moved. What's moved is the EU-specific business that sort of had to, and there will be certain people in certain financial centres in the EU who are a little disappointed to see that they haven't attracted, or what they might call, they haven't repatriated more business than has actually been the case.
Chris, do you agree with that picture? Is it the EU business that has kind of shifted, but the city's maintained the global side? I think the Lord Mayor recently said that Brexit had cost the city 40,000 jobs. That sounds quite painful.
Look, broadly speaking, I agree with, frankly, everything William has said. I actually believe the city has proven itself to be quite resilient overall in the face of Brexit. Incidentally, I hope we can eventually drop the word Brexit, because it drives me mad. I mean, I'm an unashamed Remainer. I can't understand why anybody would want to leave a single market as big as the EU. But we're out. And as the Minister just said, for avoidance of doubt, we're not going back. But it has been a very long and painful divorce. It's been 8+ years. And during that time, because of the insults being thrown, we haven't been able to have political discussions with our colleagues across the Channel. And, City of London Corporation, we have a fairly significant office in Brussels, and I would go to Brussels and I couldn't speak to the Commission as a politician. So it was really very standoff. As William said, the Windsor Framework actually opened it up again. We've now got that EU-UK financial regulatory discussion going. And William's right. The first two meetings have been, frankly, noticeable by nothing really, because they've just been getting to know each other again. This is a broken relationship coming back together, and trust has been destroyed, and trust has to be rebuilt between the EU and the UK. But when I look at the jobs, and I think, frankly, that all this figure about, well, how many jobs did it cost the City of London? It's very hard to be sure, is the answer. What we know, as William suggested, is it was nowhere near as many as the forecasts suggested. And those that went were really because of passporting, and it was mainly in the banking sector. I actually think Ireland was a beneficiary. I think probably Paris was a beneficiary. But when I look further in the EU, not so much. So I don't think Frankfurt did particularly well out of it, let's put it that way. So I think we've shown ourselves to be resilient. We've got to move on now. We didn't get equivalence. That debate is over. So we've got to look to how we rebuild that relationship, and indeed what we want from that relationship moving forward. For me, it's about, first of all, getting around the table and understanding what the frictions are. What are the frictions between the EU and the UK in terms of financial services? And then, as our regulation moves forward, and our new regulation, of course, has effectively been set under the Financial Services and Markets Act, how can we best align regulation as it develops in the EU and as it develops in the United Kingdom? And that's important. And indeed, actually, it's a win-win for both sides, actually. So I talk about the city at the moment being in a renaissance period. Not only have we survived Brexit, we've got huge global investment coming into the city. I can't tell you how many new towers we're building. I've got 11 in planning at the moment, just waiting to be built. The demand for, Class 1, fully sustainable towers has gone through the roof, frankly. And our numbers post-Brexit, post-COVID, which was 615,000 business commuters coming into the city, has gone up to 650,000. So when you look at those numbers, and you also look, incidentally, at the new jobs that have been created in the city as a result of coming out of the EU, because a lot of EU companies have found it necessary or wanted to open up here in the UK and in the City of London. So I think we've got to look forward, not look back. Drop the Brexit word, start talking about cooperation, get round the table, because it's a win-win for both of us.
Okay, just before we come back to what happens next, I guess, John, for the FCA, how has it kind of worked since Brexit, and how do you see that kind of rule book developing on your side that was inherited from the EU?
Yeah, thanks. Well, I mean, first thing, I'd emphasise some of the things that have already been said. So as William said, despite over the years, some problems in the political sphere, actually the dialogue at a technical level between regulators continued all the time to be pretty good. We have excellent discussions with ESMA and the NCAs in Europe throughout. So that's something that never really went away. Obviously, as others have said, now the sort of thawing of the political relations is the sort of icing on the cake, in the sense that it brings back the ability to have a dialogue at a political level on top of that. Those technical regulatory discussions, and that's very welcome. And others have said, we'll see, how that evolves over time. A lot is said, about the sort of question around divergence of rules and all that sort of stuff. I mean, I always emphasise actually the commonalities. We set up a whole bunch of rules in the EU together, and actually now we're going through a process, both in the UK and the EU, of often looking again at some of those rules. And thinking often in very similar ways about what's worked and what maybe needs to be adjusted. And in probably the majority of cases I can think of where we're thinking about where to adjust rules, actually there's very similar kind of direction of travel both in the UK and the EU. That said, it's impossible to sit here and say we will have identical rule books. Clearly it's impossible, not just because the UK is going to review things, but the EU is also reviewing things, and we're never going to alight on anything that's identical. And by the way, even in the EU, it's not fully harmonised anyway, so we can't think of the EU as being completely aligned within itself. So we're moving ahead in many similar ways. We obviously have to think about growth and competitiveness. We've heard that many times from the new UK government and the minister earlier. But we also, when we're going through a policy process and thinking about our rules, it's really important when we do that cost-benefit analysis that we have to do on every kind of change, that we really weigh up both the cost and the benefit side of things. And part of that is really thinking about firms who are operating across jurisdictions. We know that having divergence in rules is a cost in many cases for multinational firms. So that is a big feature of our cost-benefit analysis whenever we're thinking about these things. And if anything, that can put a little bit of a break on the scale of the divergence. We have to really think hard about whether it's worth doing things differently. That said, we obviously want to do things that are best for UK markets and support growth in the way that the Minister described earlier.
Are there any areas where you have put a brake on how far you would go because of moving too far from the EU, or as an example?
I don't know. I mean, it comes up in, like I said, in every conversation we have around policy. We would have policy discussions within the FCA about what we want to change. It's a feature of every discussion. So what's recent example, and we have to weigh up the kind of degree of difference. Like I said, it's also, I don't think we should think of the targeting being identical, because that's just impossible. But we certainly want to have things that are kind of are reasonably consistent. So what we've been doing recently, we've been revising, for example, the transparency regime around bonds and derivatives. There's been loads of work with industry working out what works well for the industry, and I should say actually the engagement we've had has been fantastic to understand what's going to work effectively. And the EU are doing revising those rules at the same time. So there's a sort of dialogue with the EU, between the industry and the EU as well, and we talk to the EU and try and understand where to get to. And by and large, those conversations around what's best for markets, rather than really thinking of it as some kind of competitiveness issue.
Mm-hmm. George, what do you think from the EU side? Does that picture ring true? Is it similar in terms of wanting to have kind of go your own way on the rule book, but end up not too far apart? And Luxembourg has also been quite a big beneficiary from Brexit. So do you agree with that picture of the City of London kind of keeping the international business, but the EU side moving into the bloc?
Well, thank you. Well, I would definitely agree with the description that there are, at this point in time, a really great number of similarities between the situation in the UK and the situation in the EU. We face massive challenges. We need to finance the digital transition. We need to finance the environmental transition. We have the whole pensions issue. We have the war to finance as well. All those huge challenges we face together. And so we face together the question of how to mobilize the resources, the financial resources, which we know are there. And of course, we both then count on the financial services industry to help us do that. Now, I think there is even similarity in the terms of the debate about whether or not we should be allowing more risk, whether or not we should be allowing the pendulum, the post-2008 pendulum to come back a little bit more. Even on those issues, I think there are similar debates. Now, whether the answers to all those questions will be similar, that is, of course, too early to say. But I do get the impression that with what we are putting in place now, the more regular contacts, the better mood, the more constructive mood, in those contacts, I do think that should help develop at least non-contradictory solutions to the problems. And if I take, for example, one of the great projects the EU counts on to solve those various problems, or at least to work towards solving them, the Capital and Markets Union, which is also to be understood as the Savings and Investments Union, and I think that says it all, really. Well, I think on that, for instance, Luxembourg's position has always been very clear. That has to be integrated into global markets. It has to be open. It doesn't say anywhere in Mario Draghi's report that the famous 800 billion should all come from inside the EU. And I think at this early point of that project, now that we have a new political leadership emerging on both sides, I think it is very much the time to make those points, and I believe that there are possibilities to actually make them now.
Is there a risk that the CMU, the desire to build up capital markets in the EU, becomes a bit more closed shop, though, and the UK is left on the outside?
I mean, there is always a risk, as the minister was saying, we should be taking more risks. But, I mean, I do believe, though, that the awareness that the needs are very great, and when the needs are very great, that does concentrate the minds. And of course, the recent American election might also contribute to concentrating the minds and to enabling people to see, well, there are still close neighbors, and then there are neighbors that are, well, further out. And so I am reasonably optimistic that even though there will be debates, some member states will be taking other positions, etc. But I'm reasonably optimistic that an open attitude will inform the project as it goes along.
Okay. And William, you talked earlier about this concept of parallel divergence. Do you think, and we've kind of touched on it as well, but do you think that's going to continue, or do you think how does that fit in now?
Yeah, I think it will. As the ambassador just said, the reform agenda on both sides, both the EU and the UK, is beginning to converge. You can look at it as in the sort of 5-6 years after the referendum, much of the debate, particularly in the UK, was about international competitiveness, relocation decisions, relative positioning between the UK and the EU. Capital Markets Union has always been what we would call more of a sort of domestic capital markets agenda. It's how can the EU get more investment in French companies, German companies, better functioning French, German, Spanish capital markets. And that's really become the focus of the reform agenda in the UK in the last few years as well. So a lot of the work that the UK has been doing, UK governments doing on pensions reform, capital markets reform, it's very, very similar to CMU, although we're starting from very, very different positions. I mean, the UK has the second largest pools of pensions assets in the world. The problem is that they're arguably just invested in the wrong place, or not where necessarily you might like them to be invested. In the EU, with the exception of a handful of member states, the Netherlands, Sweden, Denmark, pensions really are pretty low level. But what it's translating into is this sort of sense of almost copying each other's homework or shadow boxing. So a few years ago, the UK launches a listings review under Lord Hill. And a few months later, the EU launches its own version of the listings review, which incidentally was concluded and will be implemented slightly faster than the UK's version. The UK, EU is looking at, was reviewing Solvency II. The UK is looking at Solvency II. And they're looking very, very closely at each other's homework. Because, to John's point, I think neither side, none of the participants, no, it's not binary, but none of the participants here are really actively seeking to sort of diverge, certainly not to head in the opposite direction to the prevailing direction of travel on regulation around capital markets over the past few years.
Okay. I guess we are in this reset moment as well, as we talked about earlier, and you mentioned that equivalence is not on the table. So if we are in this kind of gentle divergence maybe, but what could the UK really want to improve if there is going to be a reset? What more could London want?
Well, I think it goes back a little bit to what I said in answer to the first question, in the sense that I talked about trying to minimise frictions. I mean, a lot of the work I do as I go around the world representing the city is to try and reduce frictions in markets. That's a key part of my role. And I think we need to do that with the EU as much as we can. Of course, I agree with John. We can't align our regulation. We're never going to completely align our regulation. But that doesn't mean we shouldn't try to drive forward commonality where we can. We face a huge challenge in our own rights. Now we are outside of the EU. How do we get competitive growth on the global stage? And it's one thing passing a Financial Services and Markets Act with a secondary objective for the regulators. It's another thing implementing that in reality. And when I look and we talk about capital, and I'm fascinated by the opportunities this pension reform will potentially create for capital release into our businesses. And I think I talk a lot, for example, to the fintech sector. And in the UK, in the City of London, we have an absolutely brilliant fintech sector. However, we are very, very good at startups and we're very, very poor at scale-ups. And the reason is around capital. How do we? So we launched something in the city a year or so ago called the Mansion House Compact, which saw 5% of DC pensions sort of put into a pot, as it were, to stimulate keeping these businesses here, getting them listing on the London Stock Exchange rather than on NASDAQ. Challenge is that they go across the pond, they can get a valuation 2.5 times what they would get here, and therefore we lose that. And that leads into one other point I just touched on, because a couple of the other panellists also touched on it, and indeed the Minister did as well. And it's this whole question of risk, if I may just throw it into the pot, because, we've unfortunately, since the financial collapse, made risk become a dirty word. And it shouldn't be a dirty word, in my opinion. Responsible risk-taking, right? That's not deregulation, it's responsible risk-taking, is a necessary part of growing your economy. You will not get economic growth if there isn't some risk in there. And I think what we heard the Chancellor say in her recent Mansion House speech was to some extent just that. We've got to start to talk about risk. Businesses will fail. Not every business will succeed. And regulators, we've got to stop blaming the regulators for everything. I gave evidence recently at the House of Lords Financial Services Regulatory Committee, and all they wanted me to do was to say everything about growth and lack of growth is the fault of the regulators. It's always the FCA, and they were desperate for me to say that. They got very annoyed with me when I wouldn't accept it, because they don't believe it is. The regulator has a job to do, which is to regulate, and it's laid down by Parliament. And if you, every time something goes wrong because a risk has failed, if you summon the regulator to the select committee and you bash them up and tell them this is all your fault, you clearly weren't doing your job, you didn't have your eye on the ball, you'll never get growth. So we do need to start to be a little bit more bringing back risk, sensible risk, managed risk. We need to back the regulator, not attack the regulator. It's fashionable now to blame everything on the regulators. I'm afraid I'm sitting here next to John, and I'm standing up for the FCA today.
Thank you. Good.
I won't go to John just yet, because I'm sure you're quite happy with that. But is this discussion, though, talking about increased growth in the UK and directing pension funds, how much that domestic agenda, is that a reaction to the changes that we've seen with the EU? Because the city has always been a kind of global financial centre. There has been a sense that capital flows across borders, but this is a much more domestic-focused discussion. Do you think that's a response to Brexit?
I do, in part. I think it's inevitably a bit of a response to Brexit. I mean, we believe in the United Kingdom in open markets, and we have to, because frankly, you know, we've got a fairly small domestic market, so we have to basically believe in open markets. So, yes, we are faced with that challenge now. How do we grow our businesses? How do we retain our businesses? Well, capital is at the heart of that. And so, yes, inevitably we're going to be, now we're sovereign, as it were, and we're outside of the single market. Clearly, yes, you're right, that is an important consideration.
Okay. And George, from the EU side, are there areas where you think you could work more with the UK, or are there areas where you know, the EU needs to focus on its own capital markets?
Well, I mean, I would say we have moved beyond this phase where everything was about trying to repatriate as much as possible inside the EU. I think we've moved beyond that phase. Right now, attracting capital and investors, be they EU-based or be they global, I think has now become the priority. Of course, there will be issues like the derivatives clearing, I think, where the thoughts about reshoring, or whatever you want to call it, will still be there, and that is bound to be an ongoing issue. But I think on other matters, we should be able to find more specific advances, and in particular, now that we will have more regular consultations also at the highest level, there will be a summit next spring. Summits tend to generate a need for deliverables that generate pressure on the bureaucracies to deliver specific, tangible things. And so I'm very much hoping that the relationship in the field of financial services will be part of the tangible things that could be improved there.
Do you think the political mood, when we heard from the Minister here, the political mood has changed a bit towards having the reset? Do you think that's true in Brussels as well? You know the kind of high politics quite well.
I do think it has, yes. I do think it has. The tremendous distrust and bitterness that has existed is no longer there. And as I said, there is a stronger awareness of common challenges, in particular, of course, since the Ukraine war. And I do think those things always take time, obviously, but I do think that as new officials come to look at the files and so on, I do think that it then creates an awareness that, well, obviously we must then find ways to work together and bring our common strength to bear on those challenges, rather than trying to do everything ourselves, because events are clearly showing that is a bit of a non-starter.
And on the regulatory side, John, are there areas where that's apparent already, where there is cooperation taking place?
Yeah, well, as I said earlier, I don't think that cooperation never really went away, at least, you know, in terms of our technical discussions around regulation with the other regulators. But yeah, I mean, you can see things, as I said earlier, you know, with the above that, the political thawing, that definitely opens up opportunities perhaps for things in future. I mean, in a way, there's a lot of debate obviously around this technical thing, but T+1, the clearing, is kind of an interesting case in point here. Obviously, this is a decision for ministers and the Treasury and the Commission, not for regulators. But there's a lot of people in industry saying, well, we should align the UK and the EU and the Swiss transition to T+1. Let's see what happens. No, not necessarily inside information, but if that was to happen, that's kind of an interesting test case where, on something that's fairly technical in nature, we can actually say, well, let's actually, do this together and work in close cooperation. And if that was to be the decision to do that, I see no problems in the way that the regulators would work effectively with those in the EU and in Switzerland. Equally in other areas, we have to just focus on what we're trying to do for UK markets and to support the UK economy. And we have this huge capital markets reform agenda. William's already referred to it under Mansion House Wholesale Markets Review. Long list of things we're doing. We'll continue to focus on that. And there may still be some areas where we want to do things slightly differently to the EU. This week we in the bank have announced. We're going to look at the remuneration policies, which is an example of sort of moving slightly away from the EU position. So there'll be some cases like that where we think actually it's right for the UK to do things slightly differently. But there may be other cases like T+1 is a good example where we actually cooperate and do things together. So we'll have to see how it evolves.
And is that discussion something that happens at those forums as well? Because the FCA obviously participates in them. Are you talking about where you are changing and also where there might be room for more cooperation?
Yeah, exactly. So as has already been said, the first two incarnations of that have been relatively, low-key, getting to know each other. But absolutely, there's an element of what are the issues on which we want to compare notes. Talk about what we're doing, ask, where they are on those issues. At the moment, this is sort of fairly gentle introduction to those conversations. We all know enough about stakeholder management that just building those relationships is important. It doesn't necessarily have to be just in those formal fora. Actually, build those relationships and decision points in future may become easier in other fora too. So I think that they're definitely a very positive development, and we'll have to see how some of those big decisions that have already been referred to earlier kind of play out in the future.
I think you're all kind of saying quite similar things about the picture improving, the politics improving, but in terms of the ambition, we're talking about cooperation in certain areas, but is there anything more that the UK could want, anything more ambitious or anything that where the relationship could get much closer? Chris?
Well, look, I think there has to be a little bit of slowly here.
Yeah.
Right? I don't think we want to rush in, and I don't think the EU want us to rush in. This has been a huge hammer blow to the relationship. Sorry, I'll say it for the last time. The word Brexit's been a huge hammer blow to the relationship, and we have to grow out of that gradually. You don't just go straight back to the table and put down a list of demands. That's not the way it goes. So I think we have to take it. We're talking again. Before the Windsor Framework, we weren't talking, right? Politically, I'm talking. I realise all the technical discussions continue between regulators, but I do think I would say let's take this step by step and not set out a big agenda that we want this out of an EU-UK reset and we want it now, because that would be just taking us back to square one again.
Does everyone else agree with that, or do we need more ambition in these kind of discussions? Or what about from the EU side, Josh?
No, I think I would agree with that. I mean, also, obviously, because of internal political timings in the EU, it always takes a certain amount of time for a new commission, even if it's partially the old one, but still takes some time to look at what exactly it wants to do, how it wants to do it. One field where I feel what we could perhaps or should perhaps try and be a little bit more ambitious, both because of the urgency of the matter, and the matter might become even more urgent come January, would be the field of sustainable finance. I think on sustainable finance, both jurisdictions have high political ambitions, and again, it makes sense to be working in a convergent way rather than against each other, and bearing in mind where that specific type of finance might be going across the Atlantic, it might be important to try and be more ambitious in that specific field, and it might be possible as well.
So more aligned between the EU and the UK? on sustainable finance?
Well, I mean, aligned is obviously a tricky word, but I would like the, convergence is the word that was being used, making it easier, really, to pool resources of both sides towards instruments that would be, being put to use for sustainable investments.
And perhaps less, to build on that, less active divergence. So we saw recently with the announcement on the UK green taxonomy, there was a tendency in the immediate aftermath of Brexit for the UK to, from a political perspective, to want to announce ambitions to have the world-leading framework for every single component of financial services. And there seems to be a recognition now that perhaps on green taxonomy, perhaps we should wait and see how things settle down in the EU, in the US, and then perhaps that opens the door to closer cooperation once things have settled down. Is perhaps optimistic when we're talking about the US, but once things have settled a little bit.
Well, that brings us to the US and the election of Donald Trump, who does have a different position on some of the financial services regulation. Does this, in that example of sustainable finance, but does it in general force the EU and UK back together a bit, or could the UK migrate further away in response to the US election?
Look, this is $1 million question, isn't it? I mean, at the end of the day, we don't know who all the nominees are yet. They're being announced gradually. Personnel make policies, as I always say, and until we know quite who's there, we won't know quite what the shape of the new Trump administration will be. I think the one thing we do know is that Trump by nature will be more protectionist. We have the challenge of potential tariffs, which will be bad for us and bad for trade. We know that Trump doesn't like net zero, and he will take the US, I suspect, back out of the Paris Agreement as he did last time. And we know that there will be this challenge because Trump also doesn't like the EU. And I suspect there will be a little bit of, are you with me or are you with the EU? And I think if that happens, we've got to be very clear, we're with both, right? So we have a special relationship with those across the channel because of the obvious closeness and the geography and the history, but we also have a special relationship with the United States. And my view is we wouldn't want to compromise either of those if we can possibly do it. I think for the politicians like myself, although I'm not a national politician, I think it will be a difficult juggling act, if I may say so, because we know that President Trump will want us to pay more towards NATO, more for our defence. These are things that are inevitably going to come forward. But just how radical Trump 2.0 is, I really don't think we'll know until the administration gets in place next year and we start to see, those new appointments actually putting out policy.
George, how do you see that developing, the kind of pressure from Trump on either the EU or UK?
I would say in similar terms, you've obviously from a slightly different perspective, I think there will be a huge amount of concern at this point, particularly, of course, at the plans around tariffs, the plans around the Paris Agreement. All those matters will be a matter of great concern. Of course, the US is the indispensable partner, so nobody will be telling you, oh, well, in that case, we shall sulk and not talk to them for 4 years. No, of course not. The EU will try and work with the new US administration once its policies become clearer. And I think, yes, among the issues that will need to be financed, defense will move up the agenda very, very clearly. But it is convergent with things the EU has been trying to do for the last few years anyway. The idea that we as Europeans, and now I include the UK, should collectively take more of a responsibility for our defense, for our security more broadly. I think that is something that Trump's arrival will push up the agenda, but that simultaneously should also push the EU and the UK closer, because after all, we are in the same space of security, the same space of resilience. And so most of us are together in NATO. And so obviously there we are bound to have to work together. So in other words, Trump will not necessarily mean, competing pressures and the UK being yanked away from the EU. It won't necessarily mean that. But it is, of course, true that on the EU side, there will be an expectation that pressure on the UK will be huge, and there will be great attention paid to how the UK then reacts to such pressures. Absolutely.
William, do you think the UK will react by sticking closer to the EU, or what do you think might happen?
Chris is right that we won't know the precise nature of the new administration until into January, but I think we can all imagine a realistic scenario where there is a change of personnel at the top end of regulation and supervision in the US, that there is a deregulatory agenda in the US, and that perhaps the gap in dynamism between US and European, which I include the UK, capital markets may widen. And that's going to lead to a debate in the UK as to whether we should sort of move a few hundred miles west into the mid-Atlantic towards the US, or whether we should stay closer to the EU. And a few years ago, we did a project looking at global markets where the US and the UK were already between them, the de facto global market. There were about 15 sectors of activity where US is number one and UK is number two, or UK is number one and US is number two. And ways in which they might work together, perhaps move a little bit closer to the US. I remember talking to a US Treasury official who had been working at Treasury for more than 20 years. And he said, look, all of this sounds lovely on paper. But over the last 20 years, the UK has always flirted with the idea of getting closer to the US. But when push comes to shove, it always stays closer to the EU. And I would be very surprised, even in the event of a deregulatory agenda in the US, for the UK to take what could turn out to be a relatively short-term political decision to actively seek to move closer to a US-style agenda, or closer to the US administration, than to stay within the orbit, perhaps slightly distancing itself for political effect, but to stay roughly within the existing orbit of Europe.
I mean, John, you mentioned T+1 earlier, but T+1 is an area where the UK could, in theory, have gone a bit faster towards the US, but decided to stay with the EU. Is that an area where, are there other areas like that where you can see the US might take a different approach as well, in areas like crypto, perhaps?
Well, I mean, as Chris said earlier, let's see, it's very early days. The new administration hasn't even come into being yet. So who knows? And actually, the first point I wanted to make before I answer the question is, we in the UK will remain committed, as George says, to making sure that there's still that dialogue with the US. The UK and Europe, we remain very committed to kind of the idea of international global standards being very important in the world of really integrated global financial services. So that will remain. That said, yeah, obviously there is, as William said, there's the possibility of the US kind of changing approach in some ways. I don't see, and in terms of what's already been talked about, we're only speculating what may or may not happen, but things like sustainable finance has already been mentioned as one area where we might see sort of divergence of approach in the US versus Europe and the UK. Obviously it's quite forward-leaning, some of the comments so far in terms of crypto. That's very true. I mean, we will have to, as William said, we'll have to sort of take a step back and think about it. But I certainly don't foresee a sort of race to the bottom, or us sort of throwing out the window the kind of commitment to maintaining the proper standards. Even the minister was talking earlier. There's been this constant narrative about growth from the government, but she was emphasising it has to be responsible. It has to be, we have to make the right balance between maintaining high standards and protections, but doing so in the right way that fosters growth. So I don't think that will change, frankly.
So if the US dramatically scales back some of the rule book, the FCA doesn't automatically do the same then?
Not automatically, no.
I think we're coming to the end of the panel, but there's one question from the audience on Euroclearing from Peter Wilson-Smith. Will reaching a satisfactory agreement on Euroclearing require agreeing some kind of shared regulatory oversight? Is anybody thinking about how the future of Euroclearing could shape up like that? I think we do actually have already some shared oversight, don't we, on Euroclearing with ESMA and...
The Bank of England, yeah. So that's for the Bank of England rather than the FCA clearing, and absolutely, there is already cooperation in terms of how that's managed. As the Minister answered a question on this earlier, right? It needs to be. In a way, it's for the EU to kind of say what its position is here. There's no barriers being put up from the UK side, so.
I mean, George, maybe just to finish off, is it a bit more friendly on clearing now than it was 2 years ago?
Well, I mean, all those things are relative. How do you guesstimate degrees of friendliness? But, I mean, definitely there is a more constructive attitude, generally speaking, and that also plays a part in this file here, absolutely. But there are some basic ideas out there about, a big market like the EU needing its own clearing and so on, etc., that are not really going away either.
Okay. Interesting. So we have to see on the length of the equivalence decision, perhaps. But thank you so much for taking the time to the panel. I think really interesting. It's obviously a changing moment politically, so we'll have to watch this space. But the next panel is on Buy Now, Regulate Later, led by Eleanor Meyer. So please stick around for that as well. And thank you so much to all our panelists.
Choose your seats. Okay, welcome. Thank you, everyone. So yeah, this is Buy Now, Regulate Later, where we are discussing the buy now, pay later industry. Obviously, the government has just announced its proposals to regulate this sector, which is a long time coming in some people's minds because it was originally hoped to be announced in 2021. And now, so we have Peter Tutton, who is the head of policy at Step Change. We have Ayana Vidal, who is the Director of Public Policy at ClearPay. We have Paddy Green, who is the Head of Money Policy at Which. And we have Samantha Niblett, MP. So, firstly, the government did just recently announce its plans to regulate the buy now, pay later sector. Do we think that this meets the demands of industry and the needs of consumers? Paddy, let's go to you first for the needs of consumers.
Okay, thank you. Afternoon, everyone. For the needs of consumers, yes, I think generally broadly supportive of the direction of travel here. The key elements are in there. Access to the financial ombudsman, Section 75 protection, affordability assessment. So the key elements that we'd expect from a credit agreement are there, so that's very good. Two probably specific issues I'd pick out to start with is the idea that affordability assessment is crucial, to assess whether or not people should be taking out credit is key to this. And there is, ongoing reform of the credit information market. So will that be ready to really deliver the ambitions of the government to do this in 12 months' time? And the other one, very specific one, I don't want to get into too much detail, but we know that parts of the Consumer Credit Act don't really suit this product, and putting things into FCA rules is generally, we can be supportive of that, it shows some flexibility. I think they're planning on disapplying 5 or 6 sort of provisions, but there is one particular one I think from a consumer point of view would be a bit anxious about, and that's the stuff about the disclosure information. So it's about the key information for consumers when they're taking out this agreement, because all the research shows they don't really know it's debt. And the FCA has made it clear it can't replicate that within its own rule book. So generally, very good idea. Need to get in quickly. It's taken too long. 1 or 2 tweaks, I think.
Samantha, I'm going to turn to you now quickly just to jump off Paddy's point. Do you think consumers do realise they are taking on debt?
In some circumstances, no. They are. I think they are giving themselves an easier way to afford things. But we were talking before the show. My background, I used to work for Experian and TransUnion, so I understand it from a credit reference agency perspective. And there are some buy now, pay laters that are on the credit reference on the bureau, and some that are not. And so if you defaulted on one, that wouldn't go against your credit score, and so the implications are quite small. So you might not realise it's debt, whereas others you might, although you won't have defaulted on a huge amount. So no, I think people probably just think it's an easier way to pay for things.
Anna, do you want to feed in on that? Do people realise they're taking on debt?
If I can, because I think it's. I think the two of you made really good points. What I would do is direct everybody in this room to go onto the ClearPay website right now and look at the big disclaimer, essentially, that's sitting literally front and centre, that says ClearPay is unregulated credit. You know, T's and C's apply, but also a late fee might apply if you miss a payment. Those words are front and centre of all of the communications that we send to customers. They're entirely through the checkout process. All of the materials that merchants put out under our name, they have all of that there. So I think there are always going to be challenges around people understanding all of the different financial services products that are available to them, and you know, I think it's a blessing and a curse for the UK in that we've got a really diverse financial services market. People have options, and that can sometimes make things complex. But I think, at least from a ClearPay perspective, I'm very clear that our customers are given that information up front wherever they encounter us, and I think that that's something that obviously is a standard that we want to see the rest of the industry move towards. I think there's a sort of a broader point that sort of Paddy raised about information and the fact that you know the Treasury has decided the Consumer Credit Act measures won't apply for buy now, pay later, because actually they've decided that within the Consumer Credit Act, it's basically asking you to present a 24-page contract to a customer before they decide that they want to purchase, you know, a dress through on Marks and Spencer's, for example. That's not proportionate, and I think there's a danger that actually, and you know, the work's been done on this. Fairer Finance did a really good piece of work on it a couple of years ago, looking at what consumers actually understand when they're being presented with that information, and it's fairly little. And I think one of the key things that we're keen for the FCA to think about when it does start to make these rules is, what do customers actually need to know before they make this purchase? As Samantha said, these are fairly low purchases in the grand scheme of things in terms of the cost. What are the key elements that they need to know, and how can we present that to them and make sure they understand and they're informed before they make a decision, without bombarding them with a bunch of information where they go, no, it doesn't apply to me, click accept, and they don't retain anything. So I think for us, there is a real opportunity now for the decision that the Treasury has made for the FCA to be creative and to understand how it could potentially build something that could not only provide a standard for buy now, pay later, but could also move into wider reform of the Consumer Credit Act as well, if it works well.
Peter, I'm going to turn to you now. Do you think there are enough controls in place with buy now, pay later?
So what we've seen so far with buy now, pay later, and you know, when it started, there was always this: the new payday. It doesn't have that kind of explosive harm that those kind of products did. But what we see with buy now, pay later is we see people who are in financial difficulty using it. So more likely to be in financial difficulty, more likely to be behind on sort of household bills, more likely to be using credit to make ends meet. There's a bad thing about that people use credit as a coping strategy to deal with shocks like the cost of living crisis. And that keeps people out of trouble for a bit, but what it means is the hole gets bigger and bigger and bigger, and eventually when you fall over, it's a very, very hard fall. So Buy now, pay later is part of that. It's not the only part of that. There's a general need across the board to look at how credit is being used by people who are vulnerable to financial difficulty and how lenders get better at stopping that. So bringing BNPL into regulation is really important. I guess to Paddy's point, we'll wait and see the detail on how things like the creditworthiness assessments work, and how to do that effectively in the context of this product will be important. Pre-contraction information point is really interesting as well. So the challenge there is in the nature of the product. You've got the checkout, you've got the BNPL, it's very quick. How do you ensure consumers know what they're doing, what the terms are in that framework? And that's not just BNPL. We're in a place now where credit sales are digital and they're quick, and consumer regulation is behind that. But they're the sort of controls that the FCA will now need to get right.
So we know that regulation was first suggested in 2021. The regulation that the government's proposed isn't going to be in place until 2026, most likely. Samantha, what does that say about the UK's ability to regulate prominent industries?
What the length of time it takes to get it through?
Between the two, exactly.
Well, very little happens very quickly through governments. And I think in this case, it's really important to get it right first time if we can. And so, honestly, I think the fact the consultation changes tomorrow, ends tomorrow, doesn't it? And then early next year, some recommendations are being made, aren't they? For legislation. And then obviously goes live in 2026. I think that's quite quick, actually.
Okay, fair enough. Do you think that the UK government is prioritising fintech?
Oh my goodness me, are we ever? Yeah, we are. We have got more fintech unicorns than the whole of Europe put together. We heard obviously what Rachel Reeves said in her Mansion House speech about prioritising this. I am a co-chair on the All-Party Parliamentary Group for Fintech for good reason. It is very exciting. This has been an incredible growth area for us and continues to be. And it's the depth and breadth of what fintech covers. And we'll probably, I suspect I might be jumping the gun talking about this, but we can talk about buy now, pay later being something that means somebody maybe might spiral a little bit further, but equally it's filling a gap, and it's inclusive because it's somebody whose washing machine breaks down that hasn't got a credit card to pay for that, has got a way of getting hold of a washing machine, So went off on a slight tangent then, but
No, I think it's a really interesting point, the idea that it can be helpful to consumers as well as the fact that there are risks. So one of the gaps in the regulation that's been proposed by the government is the fact that companies like Amazon are not going to be covered because they're not regulating companies that are offering the buy now, pay later services themselves. Paddy, what do you think about that? Amazon's got a lot of customers in this country, and
I think honestly, I talked about being broadly supportive of this. I'd say 90+% of it is right, but I do think that is a particular misstep from the consumer-facing point of view, because one, at the moment, people think it's a regulated product already, because we hear so much about the finance sector being, in this country is, the best regulated, and we look after our people. So there's that presumption. There's going to be a fanfare. There's lots of noise that the regulation is coming, and people are going to presume that these products then are regulated. We'll make noise about it. We're going to celebrate it. It's a good idea. But then the customer experience will be almost identical. So when you get to the checkout, it will be credit card, your buy now, pay later, and in this example, let's say Amazon Pay, whatever they have it. The friction will be the same, the interaction will be the same, and the presumption from the consumer would be that it's regulated. So that, I do think, could potentially lead to some complications down the line. I think it's one area where we think there should be an amendment. Particularly on this point, the EU credit directive has taken a different stance. So the reason Treasury have come up with this rule is based on the idea, let's say the small, referred to the mom and pop stores, people, the monthly revolving credit, that, we need that to thrive. That's a very good idea, and we support that. But when it gets to a certain threshold of the size of these people, consumers will presume that it's regulated. And I really think that's the one that needs to be the key issue, probably to be revisited.
Would you say that's the biggest gap in the proposals?
I would, yeah.
Okay. So with the government proposing measures that will be applied through the Consumer Credit Act of 1974, it'd be interesting to think about whether a 5-decade-old law can effectively regulate what is a very modern digital product. Peter, I'm going to turn to you first on this one. What do you think?
So, firstly, it's not a 5-decade-old law. It was heavily updated in 2006 and 2010, so it's only bits of it, and the bits that people complain about are about 15 years old now.
Yeah.
That's still old. Digital products were there, people were taking credit out online then, but it was there. There are bits of the Consumer Credit Act that definitely need to be amended. So we did a big bit of work a few years ago on the communications that people get when they're in financial difficulty. Some of the language and the formatting which is required by the Consumer Credit Act. And that doesn't help consumers. It's designed as a consumer protection, but it lands as a scary thing that freaks people out and makes them not read further. So the over-prescriptive nature of some bits of the Consumer Credit Act, particularly consumer communications, is much better done in an FCA environment. There's a whole bunch of other bits about the CCA that need to be kept, which are about substantive rights, and also we like the kind of some of the sanction stuff in there. So it's stuff that kind of protects consumers in different ways. There will be a debate when those things go over, and there will be a debate for BNPL about what the FCA actually do in terms of notices and content and so on. And it will be important to get that right. It'll be important for the FCA to get that right. You know, there's a bit here is how do you communicate with consumers, particularly when things have gone wrong, in a way that encourages engagement and signals help, particularly when people are sort of struggling with payments. And that's something that the FCA will have to think about a lot now.
Anna, I'm going to turn to you. What do you think?
Yeah, so I think Peter is definitely the expert on this one. But I think from a fintech perspective, I think it's really interesting. So part of the debate that we've had about buy now, pay later over the years is that buy now, pay later isn't quite a credit card and isn't quite a fixed sum loan. It's somewhere in the middle. And at the moment, the Consumer Credit Act doesn't have a definition that it can sit within. And that's one of the things that firms have been playing back. If you want to regulate the sector, that's fine, but you sort of need to understand the model and then what the benefits and the risks are to then be able to sort of fully regulate in the interests of consumers. So I think, you know, Peter makes a good point that I'd still say if it's the Consumer Credit Act 1974, then it is fairly outdated and was definitely first passed at a time when these things, smartphones, people using that to sort of spend online weren't first anticipated. And I think one of the interesting things is that other markets are obviously looking at reforming their own consumer credit frameworks, not least because of buy now, pay later as well, and the fact that it's a globally growing product. And, you know, we're founded in Australia, so we look quite a lot to Australia as being a market where those developments can help inform what we do over here in the UK. Interestingly, Australia passed their buy now, pay later Act, I guess, now this morning. So they've sort of leapfrogged ahead of the UK in terms of building that in. But I think part of the reason they're able to do that is because their framework, the underlying structure, is much more flexible. It's newer. They've actually been able to introduce a definition of buy now, pay later within consumer credit law, essentially, which is something that we're not going to get to do through this process. So the proposals are good, but we've still got all of these rigid bits that are sort of preventing us from really understanding what innovation is today, what it might be in the future, and giving ourselves the space to be able to regulate well for that.
What was it? I mean, do you think that the legislation or the proposed regulation in Australia, do you think that that's more aligned with what industry wants?
I think it provides. I think it comes back to that point about we have the structures that we have in the UK, and I think between the Treasury and I'm sure what the FCA will do a great job of trying to find a way to bring this product within the regulatory regime in a way that works. And that is obviously anticipation of broader reform of the Consumer Credit Act, which the government has accepted they want to do. And as Peter says, there are a number of very quick wins that we can have, not least around information. I guess looking at those markets more generally, we've got an incredibly complex financial services structure. Theirs is slightly more, not as sophisticated as ours. But what that does mean is they have the flexibility to do things differently. One of the innovations that we know, or one of the recent proposals that the FCA has brought in to sort of move to a more flexible approach is the consumer duty, that principles-based, outcomes-focused approach, which we love. We've supported it. Maybe we say that because we're not quite within the purview yet, but we will do, and we're obviously looking at that now to think about what that looks like as it applies to the ClearPay product. I guess, thinking about the Consumer Credit Act and how that interacts today with the consumer duty, you've got very prescriptive rules, and then you've got principles-based sort of like directives that say just do the best for the customer and provide them with you know, personalised support or communications. How do you do that when you've got a law that was, you know, devised a number of years ago that says you have to write to them in this language at a certain time, and if the full stop isn't in the right place, then the whole thing falls over. I think, you know, firms are working through that now, of course they are, but I think it's difficult for us to understand because they are two regimes that are sort of driving at slightly different, I think, approaches.
There's a thing there, though, that is that the Consumer Credit Act also has some very specific consumer protections and rights that are enforceable that protect consumers. The consumer duty kind of isn't really a tool that an individual consumer can use very well. It's something that operates at the level of the firm or the market. So there are different models of consumer protection going on there. Ideally, what you do is you get a balance. So the consumer duty is filling in the gaps, and it's telling to firms, is your culture right, is your product design right, but then you need the protections for individual consumers, and that includes when they're being taken to court and things like that. So there's a mix of things that need to come together. That doesn't undermine what you've said, that actually there's lots of bits of clash that clash, and we can unpick that, but we don't need to unpick the bits that don't clash with what you're trying to do.
Yeah.
Paddy, do you want to come in?
Yeah, I was just, well, we've spoken about this. So we slightly disagree.
Disagree? No, we're not.
No, we politely disagree on that. You're absolutely right. There are some challenges there with the outcomes-based and the rule prescription. But one of the things is, you know, we want consumers to be protected, but you know, we don't want regulation for regulation's sake, and we support innovation. But we also want them to understand what they've got, and there are elements of this act that have been around, and you know, it's the protections that are in place are probably the best understood pieces. So in any review, we want to make sure that we don't lose that, you know, so we get the balance. But on the point of the outcomes and the rules, you know, when the duty came in, it's quite clear, you know, say, you know, this is outcomes focused, but in certain areas we will have specific rules for certain needs. And obviously when you're talking about credit and debt, we need to be particularly careful. I should also say that, you know, this is a good product, right? It serves most people pretty well. I'm not sure that's come across some of the stuff we said. You know, it's a cheaper form of credit. It's often free for people. So if they can manage it well, it's really good. So we're talking about, you know, the wider regime. The issue I just want to pick out on is sort of a wider debate about outcomes and rules. So we've supported the duty if it is supervised and enforced appropriately. Yet to see any enforcement action on it yet. And have a general concern that, you know, we support the innovation, we support growth and competitiveness wholeheartedly, but parts of industry seem to be sort of picking away at that protection as sort of this sort of anti-growth narrative. And it's not necessarily the case. I think where consumers are protected appropriately, they will trust things and they will embrace them and they will use them and they will flourish. The final point I just want to make on this sort of tension between outcomes and rules is that at Mansion House, the Chancellor announced a review of the redress scheme. And if you read that, it's about, you know, mass redress events between, you know, the relationship between FOS and the FCA. So I've been doing this job here for, you know, a handful of years. Previously, I was at OFT and the CMA, and I've worked around the payment sector for a long time. And we've faced the sector that's consistently said the rule book is too big, it's too long, we need to get rid of it. There's elements of that I absolutely support, but there's duplication or the contradictory, we can move them away. And so we want this outcomes-based approach. But then looking at the views of industry that have been set out in the redress review, they said quite clearly, like, oh, the lack of rules isn't helping. We want more rules here. And the industry just needs to, I think sometimes, you know, we're talking about the entire finance industry here, that there is sometimes a lack of consistency, which from our point of view is quite frustrating. Because there's this long side, there's too many rules, we don't want this. But actually, when we're put on the line, we want these rules. So let's be honest with what's being asked.
Do you think there is a gap between rules and enforcement in general in the UK when it comes to financial regulation?
I think I would prefer some enforcement action to be taken faster. I do get that the FCA has, I mean, such a wide remit, but also when we come to the consumer duty, so just coming down to the point that one of the principles behind the consumer duty really clearly said this is going to allow us to intervene faster. Well, it's been 18 months, and we've had letters that reflect, you know, some issues, Dear CEO letters, but we've had them before. They existed before the duty. So I just think if the idea was to help, you know, intervene faster, we're kind of still waiting. So I would like to I think, sort of rephrasing the question slightly, what I would like to do is, if we are going to move away, we need to be from certain prescriptive rules. We need to be sure that the regime that is in place is working. And I'm not saying it's not working, I'm saying it's not proved yet.
Samantha, I'm going to turn to you now and ask a question. So it's about the fact that the kind of gap, the several years that it's taken for the government to legislate on buy now, pay later. Do you believe that this shows that there's a disconnect between the government and regulatory priorities?
I would say the last few years have been a little bit chaotic.
Is there a reason that you think that?
We weren't. Yeah, no, I can't think what. But it's one of the things that we've done straight away, seen as getting into power. We've said we know this needs doing. To your point, companies have said we do want the guidelines. And actually that uncertainty, which is an instability, has been the reason lots of businesses have not been growing here or not choosing to go, because they feel uncomfortable. They don't know, they don't know what's going to change. And so even going back to your earlier point on, do I think the legislation coming in the new year and then implemented the year after is a good or a bad thing? It's a good thing because it allows companies to prepare themselves, because it may affect their customer journeys. It may affect their plans that they've got for 6 months, a year, 3 years, and so. I can't speak for the last lot, but I think we've got our ducks in a row. So yeah.
Well, I like the confidence. So one thing I think would be interesting to talk about is, I don't know if you guys are aware, but Donald Trump just got elected. And one of the things that everyone is talking about in terms of his economic policy is the likelihood of some quite large tariffs, which could have a serious impact on inflation. And obviously, recently we've had the cost of living crisis, we've had serious inflation. I'm going to turn to you, Peter. How what do you think are the consequences for the buy now, pay later industry with, if there is serious inflation next year?
So, I'll take that a little bit broader. So what are the implications for people who are using buy now, pay later products? So we've just had a cost of living crisis and we've just seen that energy prices have gone up a bit. And as yet, there's not the same help for energy prices as there was last year. So we'll see how households get through the winter. But what we saw with that is people really struggling. The number of people coming to us for help was, even after debt advice, didn't have enough money to meet their basic bills, rocketed. So if we see inflation going up, we will see more people unable to pay their rent, unable to pay their council tax, unable to pay their energy bill. And what they will do is they will use products like buy now, pay later or other products to try and do that. Now, interest-free buy now, pay later is better than a high-cost payday loan, but it still makes people much more vulnerable to debt if that keeps going on. So there's some questions there about how, if inflation lands, if we have another shock to the economy, how will our households able to deal with that? We have shredded safety nets. Wages are still real wages are still low. Households are still recovering from dealing with very high energy rates. There's a kind of borrowed to get through the cost of living crisis. So the worry there is that it will tip many more people over the edge. So we got something like, a third of people using credit to pay their rent and stuff like that. So you can see that vulnerability could unfold very quickly. What happens if it does? One, in terms of lenders are going to have to be on it. They're going to have to be looking to identify financial difficulty really quickly. So a stat that we have that 4 in 10 of the people seeking debt advice from us are in full-time work. So it's like they're working, but they can't. But actually, once we've done the debt advice, we find that 1 in 5 of them still are going to struggle to make ends meet, and the rest are okay. And what that tells us is that it's mainly credit debt, because they've been using credit to make ends meet, and that's spiraled, and their lenders haven't quickly enough reached out and given them help, so the problem has got worse and worse. So people are going to have to be on the front foot, not just the lending industry. When we think about where were some of the worst bits of debt collection, it's the government, it's local government and council tax, it's these kind of things, and that's where people are going to struggle. Already we see people who are being sent to past the bailiffs for council tax collection,
Yeah.
more likely to be vulnerable, more likely to have very low incomes and struggling to pay even basic bills.
Mhm.
So these will be the consequences. So it's one of the things that we hope that government will do through financial inclusion strategy, but even more through the child poverty task force, is making sure that when these things drop, that, in particular, the kind of the government as a creditor is following good practice in helping people and not making the problem worse.
And Eleanor, perhaps if I can just
Yeah,
jump in
yeah,
there,
yeah,
'cause
please
I think,
jump in.
You know, Peter's made a really good point. I guess one of the things that I do want to do is set out, you know, how ClearPay and other responsible buy now, pay later lenders treat customers who are in financial difficulty. So ClearPay is a pay in 4 over 6 weeks product. If I use ClearPay to buy something today, then I pay 25% of the purchase price up front, and then I pay the rest in instalments on a fortnightly basis over 6 weeks. If I miss a payment, the moment I miss a payment, my access to the ClearPay platform is stopped. So I can't spend any more money with ClearPay. And you know, if actually I am struggling financially, we're going to know very quickly. We're probably going to know much more quickly than somebody who is purchasing on a credit card and doing the thing of paying a minimum payment or paying a smaller payment and just keeping that balance rolling over time, incurring more interest and having that accumulate, but not being able to do anything about it. And I find it very interesting when you receive that statement from the bank that says, if you keep on paying off your credit card in the way that you're doing, it will take you 26 years to do it. And you sort of look at that and you think, well, how is that delivering any good outcomes for consumers? So the ClearPay model is very clear that, like, if you miss a payment, then we're not going to allow you to spend any more money until you get yourself back on your feet. And one of the other things that obviously Peter raised is that there is, you know, the enforcement of debt is something that obviously we take very seriously. What we want to do, what we want our customers to do is, if they are experiencing difficulties, to contact us immediately, talk to our customer service team. We can pause payments, we can put breathing space holds on, we can put payment plans in place that are completely geared towards their financial sort of circumstances at the time. We work with Step Change, so we're often referring them to the Step Change team as well, so they can get the support that they need. We don't sell that debt. We don't enforce that debt. We work with a debt collections agency purely on a communication strategy, because we're not regulated, and that's the law. The law says we have to. But that debt, if a customer can't pay us back, then that's fine. It means they don't get to use the product again. But we're definitely not chasing them to make payments that we know they can't make. So I think I think Peter makes a really good point, but I want to sort of set the record in terms of the fact that actually these products are designed for consumers to do well on them. They're consumer-centric, and that ultimately people will be struggling or would struggle if there is a spike in interest rates and that impacts on cost of goods and services. I do think that buy now, pay later is genuinely a good product to use if you're having that short-term shock where you just need to spread payments over a short period of time.
And you know, thinking about potential economic instability, what do you think of the argument that some people make that the buy now, pay later encourages people to, you know, live beyond their means?
So I think what we've seen from our customers and how they use it is that they're incredibly savvy. Our customers are actually the savviest, I think, out there. And that's borne out by our stats. So 95% of payments are made on time, 98% don't incur a late fee. Actually, the UK is one of the best markets that we have for early payers. The 30% of our customers pay early, including me. I love paying back early. So we have an incredibly, you know, and I think there's also this, I guess, this understanding that people who are using it aren't, you know, might not be as financially literate as you might think. But actually, as I said earlier, we've got disclaimers, we've got information on the website that says very clearly this is unregulated credit. Here's what might happen if you miss a payment. Our customers are, you know, roughly 37 years old. It skews female. These are women who are running their household budgets anyway. These are the people who are buying, you know, clothes for the children, furniture for the home. They're doing the weekly shop. So these people are always and already thinking about money. And I think there are definitely always going to be a few people, you know, that people like Step Change and Which Encounter who will struggle more generally with that, but the vast majority of our customers are incredibly resilient and genuinely see this as a tool to help them manage their money across all of the other financial services products that they use.
I think it'd be good now to turn to the National Payments Vision, which was announced recently. Samantha, how well do you think that the National Payments Vision aligns with the demands of industry?
I also sit as an officer on the Open Banking and Payments, APPG. again, was at Experian when the open banking first came in, and the whole payments thing is kind of bonkers. As we've moved into a digital world where we are bombarded, quite frankly, sometimes with ways of paying.
Yeah.
We were talking before that if you're trying to buy something through an app on your Apple phone, you're rarely given other options than Apple Pay to pay for it, which means you've got to link your card to Apple Pay, and that's reducing the options that you've got for payments. You know, we've had Visa and MasterCard that have been well, they've dominated the market. I saw a clip actually of a senator in the States interviewing, I think it was Visa, and they were saying, what's your profit margin? And they were like 55%, something like that. And then they were being accused of basically helping lenders who charge massive APRs to reap in cash. And so when we see like the TrueLayer coming in and sort of disrupting the market, it's quite exciting. It's forcing, I'm not anti-Visa, by the way. I think Charlotte Hogg and the leadership team at the Women is wonderful. But it's making them think on their feet. So,
Yeah.
you know, we've got the new regulation around push payments, and digital is driving innovation, and that is exciting.
Yeah.
I think the speed with which it's changing is almost overwhelming. I think as a consumer, I mean, we know what we're doing, but as a consumer, as I look at the options to pay, even sometimes I'm like, oh my God, what's that new one? But I was talking to the CEO of Revolut, who was talking about that something like 60% of their, this is an open stat, 60% of their fraud is through Facebook Marketplace.
Yeah.
And that's not good for my constituents. That's appalling. And I know that some of them will be absolutely ripped off, and Facebook are not responsible for that, you know, and they don't care, and they could be fined if they wanted, but it doesn't matter because they're driving advertisers to their website. And so actually, I'm delighted, quite honestly, that this is all under review and being looked at, because it's time.
Just picking up on what you said about Facebook, I know in the election campaign that, you know, Keir Starmer was quite critical of, you know, obviously he didn't say Facebook, but social media companies and their role in, you know, the creation of fraud and scams. How much leeway do you think the government has to kind of step in and regulate social media companies? You know, these are big giants, but they are, you know, many people consider them responsible for a lot of the fraud that consumers face.
You go and then I'll give it a so at which we've had a long-standing campaign on, obviously, so the APP, what the reimbursement model came from super complaint in 2016-17, way before my time there. And the outcome, you know, the reimbursement model is a good start.
Yeah.
But in terms of the options that are available to government, there are options that are available right now. So I said, we face some criticism, I think, from parts of the banking sector who said it's unfair that, you know, this is all on us, and we can go into detail about why I don't necessarily think that's the case. But what we've always said is that this is part of a process, and ourselves and the banking sector very clearly supported some changes that have gone into the Online Safety Act, and there's things about these fining powers. So there are tools that are potentially available there that really need to be executed. And one of them is, you know, I get that there are resourcing constraints, but Ofcom's pace in getting it up and running is too slow. So that needs, because, you know, we've started this reimbursement model. We're part of the way there, but it is part of several interventions that really need to be done, and there is one that's available. It needs to be enacted. It needs to be acted upon, because there are these abilities to really find these companies. If I mean, the breaches are for a variety of things that go way beyond the specific one that we're talking about, but that's a really good start.
Yeah.
You know, industry have asked for it. We'll support them and others in making sure that that is really delivered. On very quickly on the national payments vision, we spoke about this, and actually we were in agreement. We both thought it was pretty much okay, which is nice, I think. But one of the focuses on there, you talk about open banking, is again really supporting innovation. But one of the things that really came through is within the payments vision. It talked a few times quite clearly, and I heard the minister who was just passing me on the way out the door at an event last week, that the very key role of consumer protection in payments.
Yeah.
And one of the things is it's so clear, and you know, the Ghana review last year made it very clear that the absence of a clear protection model around open banking has inhibited its growth because consumers don't trust it. So don't, absolutely want innovation here. I really think that there's potential for huge growth in the financial sector, especially around payments.
Yeah.
But for those of you who may or may not be working in this space, please really look at that consumer protection element, because it is shown when they don't have the protection, they don't trust it and they won't embrace it. Whereas if it is there, they will give it a real go.
Yeah.
Things can fly.
Yeah. Samantha, do you want to jump in on the kind of, social media regulation, that sort of thing, protection for consumers?
Yeah, as a mother to a 17-year-old daughter, I live in constant minor panic attack that she's buying things on TikTok. And I'm grateful that her generation don't really engage with Facebook. So sort of marketplace, she's less likely to be ripped off buying a fake pair of Uggs or something. But it's always that battle, isn't it? I mean, it's an ongoing battle around the ability to grow and not stifle innovation, and that America, fail fast mentality. I was at an event on crypto in Parliament yesterday. What day of the week is it? And Stephen Bartlett was on stage being interviewed, and he was talking about, he goes to his office in San Francisco, and it's kind of all, great, this is the atmosphere, we fail fast, I have a fail fast team. Elon Musk is great. And then, I'm paraphrasing, but and then he said he flies back to London. He can really feel the difference. But also America has an appalling workers' rights, and and so it's really hard for us to be bombastic and innovative and whilst protecting the consumer. I realised way before I joined the Labour Party, I was quite late doing it really. I realised that, I've always been wired this way, because I was really happy when I worked at Experian and I worked in consumer services at Experian, and I did the first deal where you get your credit report as part of a credit card, a Barclaycard. And I remember when we became FCA regulated, it felt great, because do you know what it meant? It meant we had to do the right thing, not just say we were doing the right thing. And that gave me comfort that we were protecting the consumer. We were still doing cool, innovative things, but it's a balancing act, and that's why I'm grateful we've got the regulation. We've got this regulatory office, and so we can try and speed things through that need to be sped through, and slow things down that need a proper look at.
Anna, do you think that the government is kind of moving fast enough for the payments industry in this country?
I think we, as Paddy said, really glad to see the National Payments Vision, because it is long overdue. I think my tenure in the fintech sector more generally, we've seen about 7 or 8 payments reviews over the last few years, and none with any sort of, meaningful outcomes coming out of them. So I think it's good to have this now, and I think this strategy is genuinely can take us forward from where we are before. As Samantha said, we're a market that's sort of dominated by cards, but other markets are doing things differently and are improving financial inclusion, for example, by offering other methods of payment and reforming that. I was in India last week, so I will talk about India as an example, but India, for people who don't know, but I think most people in this room will be aware, introduced essentially a sort of a digital ID, a national identity for all of its citizens to enable, and now that is linking them basically to the banking sector, and they're able to pay each other through UPI. So when I was in India and I wanting to pay people, I struggled because we don't have a payment system that can match up with the UPI system that they have over there. So that's really interesting. I think that there's a real challenge for us to think about when these models are being created, how we can make that truly interoperable across international markets. But seeing it in action was really interesting, because I've heard so much about it as being like, this is a genuine innovation that is allowing people to pay directly between their bank accounts. And the government has really taken a strong stance and been able to introduce this. And I think, Samantha, I agree with you, we're British, so we don't really like being bombastic. I think we can be bombastic in payments, and I'm hoping that the MPV is the start of some of that.
Could you see any sort of way that Britain could enact something like that, or do you think it would take, a decade?
I mean, apparently we're not talking about digital ID at this, but I think that's a whole separate thing.
A whole nother topic.
Yes, exactly.
We could have a whole nother panel on that. I just wanted to pick on up on something you said at the beginning about, lots of kind of visions and strategies coming out. And I was listening to the former City Minister, Bem Afellamy, yesterday, and he was speaking about the Financial Conduct Authority, but he was talking about this like death by consultation, like the really slow pace of change when it comes to change the rules in the financial services industry. Samantha, what do you think about that, about the pace of change?
I think it depends where you look. Mm-hmm. Honestly, I think it depends where you look. Some things feel like they're just moving far too slowly. Yeah. And other things you feel like you can't catch your breath because the rate of innovation is so exciting. Yeah. And also one thing that's really important, I'm conscious of time, but one thing that's really important, I mentioned I'm a mum to a 17-year-old. I was talking to her about money. She started with a Go Henry at about 10. She's now got a Starling account. That's been, you know, when she was born, she had a Halifax account, right, with a book. She said, when she gets money for her birthday, she goes, Mum, can you put that into my account, please? So she gives me the hard cash and she wants it digitally. She goes, this doesn't feel real. My money going down in numbers feels real. It's the other way around for me. So I think we just need to be really mindful that actually the next generation coming through actually are all about digital and money in the way that perhaps as a 45 almost year-old woman, the way my relationship with it and transferring it and sharing payments about it with my friends completely differs to the next generation.
We are running out of time, but thank you very much to all of our lovely panellists for taking the time to come and speak with us. I believe that Fiona Maxwell will be coming on stage soon to tell you about the rest of the day. But yeah, thank you so much.
Thank you. Thank you.
Yeah, I have the wonderful job of telling you that it is drinks o'clock. For those of you who are joining us, we've got a happy hour downstairs. I just wanted to say thank you all so much for coming. Thank you to those of you who joined in person, and I know we had a lot of people watching online as well, so thank you to you as well. Also want to say a great thanks to our partners, City of London, ClearPay and ISDA. This wouldn't have been able to happen without you. Also, thank you to our wonderful events team who have put this together and got some really, really great speakers. So much appreciated, and thank you to all the speakers as well who shared some really valuable insights. I personally think it's been a really great day. I hope you have all enjoyed it. And please get a glass of something. It will be downstairs and we would love to chat with you more. So thank you all very much.